Good morning. The drama. It's Jobs Friday, February 3rd. Brad Smith has just pointed out to me it's 2-3 today, ladies and gentlemen, on the calendar. This is Yahoo Finance Live. I'm Julie Hyman, alongside the aforementioned Brad Smith, as well as Brian Sozzi. And if we take a look at futures ahead of the January jobs numbers, we see a little bit of a downdraft here following a raft of disappointing earnings from big tech last night. We're going to get to those much later, but that is the reason that you see the Nasdaq doing the worst of the three major averages before these numbers here this morning. Let's run through the main estimates here coming from economists. Economists estimating non-farm payrolls went to 189,000 in the month of January. We're looking for an unemployment rate of 3.6% and average hourly earnings to have risen, as you can see, 4.3% year over year or 0.3% on a month-over-month basis. And guys, we each have our things that we are watching for in the jobs report. Saz, what do you got?
I was still trying to wake up from that Apple earnings call. I was like, Brian, what a slog. But as for me, I'm looking at a good chart from the team over at Goldman Sachs, pointing out the layoffs, looking at from the Challenger Grain Christmas survey. You see those layoffs spiking, of course, big tech, but of course, a lot of these job cuts are now spreading to the manufacturing space. But you see that spike up, yet has not been reflected in initial jobless claims, and that has some, I think, looking for maybe some upside in this jobs report today.
Yeah, I'm keeping an eye on, of course, the unemployment rate, and there's a question of how much this report matters to the Fed. The Fed, of course, is looking for a trend here, and even this week, saying from Fed Chair Jay Powell within their press conference, saying that despite the slowdown in growth, the labor market remains extremely tight. Unemployment rate near 50-year low here. Job vacancies still very high, and wage growth very elevated right now. So with that 3.5% unemployment rate and the expectation looking for something closer to 3.6%, yeah, we're still in the same ballpark there. It's just a matter of where there does start to resemble some signs of weakness here in the employment situation.
Yes, indeed. And so we also have this debate about whether there is still tightness or slack in the labor market. The signs point to slack at this point. And my chart comes to us from the Fred blog, which is looking at the labor force participation rate by age group and noting that the group that really has not recovered as much as the others is the 20 to 24-year-old cohort. Prime working age, right, for those who are not getting a higher education, and yet those people have not returned to the workforce in the same numbers as 25 to 54. That's the cohort that is the closest to where it was pre-pandemic, and then, of course, to older Americans either. But this suggests, because the participation rate is still not back up overall to where it was pre-pandemic, that does suggest there's still some slack, right, in the labor market. So that's something to note as well. Something else, just sort of a technical note I want to say about today's jobs report. It's the benchmark revisions report that they do annually. So going back to early last year, they do some revisions to those numbers. So not necessarily going to have an effect on It's not going to have an effect on what we're seeing today, but just something to keep in the back of your mind here.
Also something to keep in the back of your mind, just listening to some of these tech earnings calls last night, notably the one out of Alphabet. I think if investors thought big tech was done cutting employees in large quantities, you best think again. You have now Alphabet looking to close various offices, various facilities, spending millions upon millions of dollars to get out of these locations and perhaps can more people. Heard from Meta earlier in the week. It remains very focused on efficiency. So I get that this jobs report, maybe it's a surprise to the upside, but we could be looking at some tough reports as the year goes along, as some of these big tech layoffs get even worse.
And that's what's catching so much attention. That's what's making it to the brunch table barometer. I'll bring it back to here. That's what making it to those conversations is when you hear some of your favorite household brands and names announcing that they're making these major job cuts. Of course, Apple, as of right now, still abated from that conversation. But for many people who have been watching this across some of those consumer technology names, that starts to add up in their mind. It's just a matter of whether or not the Fed is saying, yeah, but here's the thing, there's still slack to your point, and it's not showing up on a more broad scale or broad basis right now.
One of the other things we have to watch when we look at average hourly earnings is the mix of workers that are still being added. In other words, as we see more workers being added on the hospitality side that are maybe lower paying jobs, and not as much hiring on the higher salary information side, we're probably going to see some mitigation, moderation in that average hourly earnings growth, which, to come back to the Federal Reserve, is what the Fed wants. But is this jobs report going to make the Fed's job more complicated? Probably, because these jobs reports have been holding up and have been relatively strong. So again, as we await the numbers, 188 or 189,000 is what we're looking for from these numbers. Let's see what we get here as this clock strikes 8:30 and we wait for these numbers. I'm looking for some of them to populate. 517,000.
Wow.
517,000 jobs added to the U.S. economy last month. Let's run through some of the other numbers as I get over the shock of that. 3.4%, the unemployment rate, so falling instead of rising. Average hourly earnings indeed coming in line with estimates with a gain of 0.3%, although it's 4.4% on a year-over-year basis. So let me say that number again, folks. 517,000 jobs added to the U.S. economy last month. 188 was the latest estimate that we were looking for, 223. So talk about making the Fed's job more complicated, right? We heard from the Fed earlier in the week that disinflation was happening, that inflation is slowing down. The rate of inflation is slowing down. The market was overjoyed about this, right? We saw stocks take off. This suggests the Fed has more work to do. Yeah. So I would imagine that we are seeing stocks plunge down pretty quickly. I don't know if we have a chart of futures.
Julie, it's not just the headline here. You go down to the bottom of this jobs report. We have upward revisions to November tallying 34,000. You have December revised up by 37,000. So not only did we have a blowout jobs report here, but the prior 2 months are showing that the economy was perhaps stronger than people thought, which, to your point, Julie, really, I think, makes things tough here for the Fed in their coming meetings.
Some of the context that the Fed had laid out coming into this print as well is that employment had risen by an average of 247,000 jobs per month before this. This is certainly going to bring that average up. You look across some of the strongest job growth, and they said it was widespread, led by gains in leisure, hospitality, professional business services, healthcare as well. Employment also increasing in government and partially reflecting the return of workers from a strike there. But this, an amazingly just outsized print and catching the markets by surprise here this morning, too, as you're seeing the Nasdaq futures, which had been leading the charge this week, down by a little bit more than 1.5%.
Yeah, on that front, I think usually we spend a little more time talking about this, but given the shocking number that we just got, Jared, I think we got to take it over to you and see what we're seeing in the markets here in reaction to that blowout number.
Sure thing. I'm watching the S&P 500 futures sell off a little bit, but not as much as I might have thought, given the strength of that number. I have a 3-day chart on here because I wanted to see the reaction to Powell and the FOMC, the Fed, on Wednesday. We know that the Fed doesn't necessarily like high stock prices and easy financial conditions going into its report. And there was a lot of talk about and consternation about the fact that Powell didn't really push back against the risk-on narrative that was prevailing. He said that a soft landing is not even his base case. It's kind of an outlier event. Nevertheless, markets decided to run with it. So we'll see what's happening. We see what's happening in the S&P futures. Let's take a look at Nasdaq. That's off just a little bit right here. And then let's get to the futures in the Treasury market as well. So here's where we're seeing an outsized reaction. Big move to the downside. Again, this is a 3-day chart. So here's where we began on FOMC day, and we came back down and tested that. That's going to be my reference point throughout the day. This is a 10-year. Let's take a look at the 2-year where the action is. We can see that came down just about to the FOMC announcement time as well. So we got a reference point for the 2-year, and this is what I'm going to be tracking most of the day. Here are gold futures, gold off just a little bit. Here's copper down a little bit, but really it looks like the market is expressing itself as shock in the bond market and not necessarily equities here, at least equity futures.
Yeah, definitely. That's what we're seeing, especially considering that round trip we have taken from the Fed earlier in the week. Yeah, no, it did not. Jared, thank you very much for that. So just to recap these numbers and the surprising nature of them that we got just moments ago, 517,000 jobs added to the U.S. economy. You see that is more than double the estimate of 188,000. The unemployment rate falling to 3.4%. Average hourly earnings ticking up by 4.4% on a year-over-year basis. And as we were talking about, some of the groups where we're seeing additions, leisure and hospitality, as we talked about, continuing to add 128,000 jobs. The weakest groups in terms of job gains or even seeing some job losses, areas like information, i.e. tech, right? That's no surprise, and financial services. Yeah, and it really comes back to as well within this that labor force participation rate, 62.4%, employment population ratio sitting right now at about 60.2%. So slight changes there on the labor force participation
inflation rate. But then again, just that 3.4 unemployment rate, as we were kind of having our conversation ahead of time, and that was the chart that I was calling for here, that was the focus here, and that's going to continue as well to be the focus for a Fed that has leaned on a strong employment situation as to continue forward in their pathway on policy front.
Yeah, and we've seen some divergences in past reports between the establishment and the household survey, i.e. non-farm payrolls and unemployment rate. Not so this time. They're both going at least directionally in the same direction. All right, let's get a deeper dive into the report. New York Life Investments economist and portfolio strategist Lauren Goodwin is with us, and RSM chief economist Joe Bruce Willis. Whew, guys. So, Joe, I have to say, you were flagging going into the report that you had seen some estimates that were starting to move up in dramatic fashion. But not this dramatic of a fashion. What the heck?
Okay, let's all take a step back and breathe. January has lots of seasonal noise attached to it. This report, however strong, exaggerates the true underlying pace of hiring in the economy. Okay, once you start to unpack this, what you're seeing is, okay, wage growth is high, but it's decelerating. Okay, second, everybody out there in the market got on the wrong side of the Fed this week. This jobs report, if you really want to watch the impact on the market, look at the 2-year yield. Before probably 30 minutes pass, we'll go full round trip back where we were before Powell's press conference started. All right. Second, hiring is still strong. It's too strong. We need to generate some labor slack in this economy to ensure that we get back to 2% inflation at one point late next year or 2025. Finally, too many people are going to conflate this today, and they're going to overreact. And I just think it's really important here. We get all kinds of noise every January. Every once in a while, you get one of these big outliers. I would take this with a grain of salt, focus on the underlying trend, and proceed accordingly.
Well, Lauren, doesn't this raise, just push back on this notion that I think the market priced in this week that we will get a Fed pivot? I mean, this is a very strong report.
It is a very strong report. I think actually that the market's been on the wrong side of the Fed for a year. It's been time after time after time that the Fed has been, frankly, pretty consistent, especially in the last 6 months, with its messaging on where the terminal rate is going, what they expect they'll need to do in order to bring inflation under control, and the importance of bringing inflation under control for the average household. This week was no exception, and so I agree with what Joe's saying in that the underlying trend hasn't changed a whole lot. And the cyclical rally that we've been seeing over the past couple of months, especially in January, that's been fueled by hopes for a Fed pause, as well as some international growth risks moving off the table. This is a meaningful gut check and on at least one of those factors.
If you're Fed Chair Jay Powell waking up this morning, you see this print, you're putting on your slippers, what do you think to yourself about that terminal rate at the end of the day?
Well, I think the terminal rate's going above 5% is what I think. The Fed pretty much told us they were going to raise rates, 3 more times at the December forecast, right? They hiked it by 25 basis points this week. They're going to do it again in March, and they're going to do it again in May. Then maybe we can take time for a strategic pause to let the economy continue to absorb those 6 supersized rate hikes that happened last year. I got to tell you guys, market's wrong all of the time. The market's really out of alignment here. This actually, I think, is probably a good thing for the market over the medium term. But today may be a bit painful.
Well, listen, the market's out of alignment because Jay Powell put it out of alignment. And so, I mean, you could say, Lauren, that he was sort of clumsy at the press conference. If indeed, he was asked several times, are you concerned about loosening financial conditions? And he didn't really come out and say, yes, I am, which is what he had done in the past that slapped the markets down. Why do you think he wasn't more aggressive there?
To be honest, I think it's just because we are getting close to the point that the Fed has identified where it'll be a good idea to sit and stop and let these long and variable lags take their effect. So again, for months now, the Fed has been saying that a 5 to 5.25 terminal rate target range is likely to be appropriate. And that's, as Joe pointed out, that's a couple hikes away. It's fairly typical, even as atypical as this economic cycle has been, it's fairly typical that the labor market would be the absolute last domino to fall in the trajectory of an economic cycle. We were running some data and surprised me actually, that 9 out of the last 10 recessions, employment was still growing when the recession began. Right. And so this is not actually so unusual. And so for Powell to say, hey, we're going to hike 2 more times, 25 basis points each, and then it makes sense to sort of sit and let things play out, that's a reasonable approach. I agree it could have been more direct about that, but the market was likely to take that as dovish no matter which way.
Yes, sometimes it hears what it wants to hear. True.
Part of the surprise here, I think, is that for the past couple months, all we've been hearing is about layoff announcements, notably in big tech. Why did they not show up here, and when do they start showing up?
Okay, they're not. Okay, there's a couple things going on here. First, the median duration of unemployment going into this report was 8 weeks. I haven't had a chance to see the report. People in tech have skill sets that are in demand across the entire economy. So I live in Austin, know a kid who makes $275,000. She's 27 years old. She works at Twitter. If she gets laid off, she'll find a job like that. It won't pay $275, it'll pay probably close to $200, right? They're getting jobs. Moreover, they get long severance packages. Some of them are doing contract work. These people, I mean, they're
never show up.
Even, as we've talked about, even many, if not most of the companies that are laying off are also still hiring.
That's right, yeah. I mean, you're getting just a right sizing of the workforce. In labor, there was labor hoarding because those people are impossible to get. I mean, these people are really in demand across the real economy. And I want to come back to something here. Powell has a remit to make policy for the real economy, not for financial markets. And everybody needs to understand that when we've had a historic inflation impulse, had a 20-month peak, and we're now seeing some disinflation, that's mostly correction in the supply chain, not disinflation because the economy's, going to have a real long-term problem. Yeah, I understand why there's some misalignment, but he needs to continue down this path. Financial conditions are still roughly 1.5 to 2 standard deviations below neutral. That means it's a drag on the economy. It's not as bad as it was 6 months ago, right? So everybody gets on TV and says, well, financial conditions improved. Okay. No, they have not. They are tight, and they need to remain there so we can restore price stability, because price stability is what counts in the real economy.
For consumers that, yes, many of them who are working and are looking for that price stability as well, at the same time as they're looking to perhaps outpace some of where the prices have risen to at this point in time before those prices perhaps start to retreat or normalize once again. What within the wage front here that we're seeing within this report gives them confidence that they can see wages stabilize for an extended period of time in order to weather what is still an inflationary or at least disinflationary starting environment?
Not a whole lot, to be honest. Real wages have been declining since April of 2021. That's why this has been already such a challenging environment for so many families. Actually, the number one question when I'm speaking with clients that I get when we start talking about recession is, aren't we in recession already? That's how it feels. And that is why some of the conversation and frankly, the market movement around a soft landing, I think could be misplaced. I'm not convinced that a soft economic landing under these conditions is what makes the best economic outcome for the most people, because recessions, though painful, provide a really important service, which is to reduce or eliminate imbalances. Typically in the last couple of cycles, it's been some sort of leverage. Household leverage, corporate leverage. In this cycle, it's inflation. And that's why Powell's out there saying, including in this week's press conference, unless we are able to bring inflation under control, the economy works for no one. And so wage growth here, persistent, that's good news, but not if it's continuing to fuel companies' need to raise prices higher.
So look, we've just turning the corner on real wages. They're just moving into positive terrain. Consumers, after that 20-month shock, are just getting a chance to breathe and get ahead. I just looked at the unemployment rate out to 3 digits. It's 3.434. That's lower than anybody's lifetime who's in this room right now. I mean, this is extraordinary stuff that's happening.
I want to circle back to the beginning when we were talking about January.
Yeah.
Because I want to do a little impromptu Yahoo You. Why, just break it down for us in simplest terms. Why is January weird, and what, like, they changed they changed the denominator, right? In January. Talk to me about what's happening.
It's real simple. People quit jobs. Hiring gets reset. Wages get reset. It's very difficult to estimate.
Every January.
Every January. So the seasonals are really, really important here, which is why, yeah, the labor market's too strong, but it's not that strong, right? What I'm really more interested in is that labor force participation rate, the 3.4% unemployment rate. And hey, guys, look at the household. Remember a couple months ago, all the sharks in the market were like, this isn't true, look at the household. We almost had 900,000 increase in household employment. That's statistically significant, and that's huge.
Lauren, what do we do with all of this information? What action do we take from here for the people who are looking ahead at 2023 and they want to make money and hopefully make back some of the money they lost last year?
Well, look, I think that this is likely to put a tactical hit on what has been otherwise a risk-on cyclical rally. Again, not only because the market is getting a line of sight on the Fed's terminal rate, but also because we've seen some important global risks at least pause for now, including the energy environment in Europe, China's economic reopening, et cetera. For investors, that can be really tactical. The next couple of days are likely to be a little choppy after this data, but some of those positives for the economy still stand. Most investors aren't able to be so tactical. And as the way that the economic evidence is stacking, it's very clear that we are going to see slowing economic growth and continuing deterioration in margins over the course of this year. So we're actually leveraging the strength in markets recently as an opportunity to rebalance towards themes that are a little more durable, focused on income generating in the market, and just an acknowledgement that as certain as Joe and I and anybody can come up here and sound, this is an economy with a large confidence interval. It's just such an uncertain environment. And so why leave up to chance and market timing what you can generate in a portfolio via income and a little more durability?
Joe, what do you think we might hear from various Fed officials in coming weeks when they hit that speaking circuit?
Oh, you're going to hear them reinforce what Powell attempted to put forward, which is the rates are going to increase. We may take a pause at one point, but that doesn't mean we're necessarily finished. Mm-hmm. They need to finish the job here, Brian. I mean, if they're going to reestablish price stability, they absolutely have to err on the side of caution, even if that means the Fed causes a downturn in the economy for a brief period of time that's quite mild.
And Lauren, it looked like I wanted to add something after that, and I just want to add this onto it. If you're looking at this print, what is the first trade that you make after you read this report?
Well, the first thing the thing that I was going to add to what Joe's saying is that, as you were discussing earlier, it might appear that this job report makes the Fed's job harder. I think it actually makes their messaging a lot easier, a lot more straightforward. It makes the market's job harder. And so, again, if you're able to be incredibly tactical today, this is a moment for a cycle back into the improvement in value equity over growth. In investment grade credit over high yield, et cetera. But tactical isn't for everybody. So the medium long-term focus we think makes sense.
I think all of our jobs just got a lot harder today, that much is sure. New York Life investments economist and portfolio strategist Lauren Goodwin and RSM chief economist Joe Basuelo. It's good to see you both. Thanks so much for the insights. Tremendous.
Thank you.
All right, again, non-farm payrolls rose by 517,000 in January. The unemployment rate little changed at 3.4%, really surprising markets on both accounts. But coming up, while it's a big day for reads on the economy, it's also a big day for tech. We'll pick apart those weak Alphabet earnings next. The digital advertising slowdown is escalating for Alphabet. The tech giant posted its fourth consecutive drop in profit in Q4, falling 34% year over year. But YouTube specifically seeing a nearly 8% decline in ad revenue. Roth Capital Partners Managing Director Rohit Kulkarni joins us now. Rohit, always great to get some time with you. Is this just the start of several bad quarters for Alphabet's advertising business, or was this the bottom?
I would say we are in the, sorry to use a baseball analogy here, we are in the probably bottom of fourth year. By that, what I mean is we're somewhere in the middle as far as downward revisions to where Alphabet might be going. In my opinion, Alphabet did earn a lot of incremental market share during 21 and 22. A lot of that was at Facebook's expense because of some Apple changes. I feel that slowly changes over the next 12 months, plus the economy. So I feel they are in this kind of middle ground where probably they are going to lose a little bit of extra market share. And on top of that, there is the ad recession, in my opinion.
Would you be concerned if you're Alphabet about who you're losing market share to and whether or not that market share will actually return?
I think it remains to be seen. As the pie starts growing again, in my opinion, perhaps we are not there yet. At some point in 23, we'll start to see the evidence of the digital advertising pie is growing at the clip it used to prior to the pandemic. High single digits, low double digits. When it starts, probably the incremental market share, Google will start earning back. But in the meanwhile, I think right now they are in a position where people spent a lot of extra money on search, and now they're finding better ways to find not just to Facebook but TikTok, to even Apple search, Instagram. So there are more places that are more settled down right now than what YouTube and search seem to provide. So that's I wouldn't call it this is kind of the peak market share for Google right now, but they're in this kind of window or a tunnel where they probably are going to be losing a little bit of market share.
Rohit, we just got a big jobs report, a big jobs report, a big number of jobs being added in January. Of course, Alphabet was one of the companies that announced cuts during the month of January. Are those cuts done at Alphabet and or at other tech companies?
I'm afraid in some cases like Alphabet, the signal yesterday that we got, which was a little bit of a surprise from the management team, is that they are going to slow down hiring, which was not something that an investor looking into a recession was willing to hear. So I feel there could be a change in stance, maybe 2 or 3 months down the road, where a company like Alphabet may feel the need to do additional cuts. May not be completely in headcount, but there are many different ways that these companies can save money. Be it office buildings, be it real estate, be it travel, and various different ways. So I think there could be a combination of the ways that they would be looking to save some cash and just to kind of improve the sentiment with investors. So headcount reduction, possibly we are almost done. There could be small tidbits here and there in the next 3 months, but there would be, in my opinion, more cost reduction initiatives that would come out of Alphabet, is what I think.
Something else I want to ask you about is artificial intelligence, because Rohit, I heard one stat this morning that they talked about on the call. They mentioned the words more than 50 times. You know, I have to say I don't listen to all of Alphabet's earnings calls, so I don't know. Maybe they've been talking about this for a long time, but forgive me for thinking like they're kind of jumping on the bandwagon here. I mean, what's the real opportunity here in AI for an Alphabet?
To be honest, as in from an investor perspective, Google has been a leader in AI for a number of years. We don't see that at the surface on the products, but under the surface, in my opinion, Google has always been a leader in AI. In the last 2-3 months, once you start seeing consumer adoption of new AI products, ChatGPT, for example, is touted as one of the fastest growing consumer products that people are adopting for AI. So I think Google is now forced to stake a claim that and remind people that, hey, look, we've been working on this for a number of years. We acquired DeepMind many years ago. Now they are going to provide more accounting disclosure on DeepMind. They talked about AI and new applications of AI that they are going to unlock and show consumers that, look, you can play around with Google-generated AI tools, just as there are many other places that you are doing right now. So I think, in my opinion, Google still remains the leader in AI. It is just that they are now forced to remind investors that, look, we have been working on this for a number of years. Just because a new toy or a new shiny whistle is coming along, don't forget about us.
And 20 seconds, Rohit, will a DeepMind-enabled Google search be able to go up against a ChatGPT-enabled Bing?
I would definitely put my money behind Google DeepMind and their search capabilities.
Rohit, thank you so much. Roth Capital Partners Managing Director Rohit Kulkarni. Appreciate your time on this Jobs Friday and also Big Tech Friday. Thank you.
Thank you.
On the former front, let's recap jobs real quick. The U.S. adding 517,000 jobs in January. Unemployment rate falling to 3.4%. Wage growth, though, still under control, rising 0.3% month over month, 4.4% year over year. Coming up, we're going to break down the top 3 things you need to know, including some more big tech earnings. That's next. $9 a.m. on this jobs day here on the East Coast, still 30 minutes away from the trading day. Let's get a check-in on how futures are trading here as I and my compatriots sift through this morning's jobs data. We have S&P futures that took a sharp turn for the worse after that much better than estimated jobs report. Nasdaq 100 futures, as we've talked about so frequently, big tech reacts more to perceptions about changes in interest rates. And what this report did today was perhaps reset those Fed expectations that they are going to have to keep raising rates. Nasdaq 100 futures down 2%. And then as we look at the Treasury market here, showing the prices of Treasuries, that means yields are spiking here this morning, reflecting that perception about where interest rates are going. The move on the 2-year also quite dramatic. It is on the shorter end of the curve, meaning it is even more reactive to perceived changes in the future trajectory of interest rates. So price down, yields up there as well, Saz.
All right, here are 3 things you need to know right now. The January jobs report blows past expectations with 517,000 workers added and hugely complicating the picture for the Federal Reserve. Is this a big shock or just a noisy number? We'll discuss.
And Apple earnings coming up sour, missing expectations on the top and bottom lines. We're going to break down the number for the iPhone maker shortly.
And Amazon earnings are thing 3 as they've been a bit cloudy as online store sales came up short of Wall Street estimates. So what does that mean for the consumer? We're going to dive into that and much more. But first, let's get into the first thing here this morning, the first big thing that we have been keeping our eyes on here, and it has been the jobs report as well here. And Julie, as we're continuing to really kind of parse through some of the numbers here, I mean, the growth that we had seen far surpassing what the big expectation was coming into this.
Yeah, we were just looking at these charts here. If we look at the 3-day, as our Jared Blicker was doing earlier, that shows exactly what happened from the Fed meeting the other day and then the trajectory until now. So basically, we have now come full circle since then. If you look at the futures as well, not quite the same magnitude, right, but directionally going back in that direction. So that's effectively what we're seeing here. If we look at some of the heat maps and look at the Nasdaq 100 here, which is where we are, the numbers on the bottom are mostly in the red, and that's where we find a lot of the tech stocks this morning after that number, and also after, obviously, a lot of numbers from the individual companies as well, Sas.
All right, let's take through these. Thing number 1 you need to know today, jobs jump, coming in well above the 188,000 expected, and unemployment rate falling to 3.4%. Guys, let's try and dive into these numbers. Real blowout report here. I really like the analysis moments ago from Joe Brasuelos and Lauren Goodwin they provide to us, but a big report, certainly pushing back, I think, on some of this hope or hopium in the market that we might get that Fed pivot and get it very soon. This report suggests maybe that's not going to happen. You know,
one of the other things that was mentioned by Joe when we had him on set here was that this is the lowest unemployment rate reading when taken out to the thousandth of the decimal point that we've seen in our lives here, at least anybody that was here on this set. So that is significant. However, it's also significant from the fact that Fed Chair Jay Powell, waking up seeing this number, perhaps looks at it and says, okay, well, looks like we can do a little bit more work on this. And that's certainly rattling the markets, as Julie was just breaking down at the touchscreen a moment ago.
Yeah, and so, you know, we were just talking to Joe Brasuelos and Lauren Goodwin a little bit ago and their reaction to these numbers. And Joe's message was really that while this is a big number, it's not as big as it appears to be. Mm-hmm. And I've seen some other commentary on Twitter and the like as well, including from economist Justin Wolfers, that if you look at the hourly earnings number, yes, it was up 4.4% year over year, but if you look at the month-to-month change, it was 0.3%, bang in line with estimates. And so that's really the number that the Fed is keying in on. If, in fact, it is trying to attack inflation, maybe doesn't change the trajectory as much as the market seems to think it is today. So I think maybe it's a little bit more nuanced than that big 517 is on the surface.
Yeah, leisure and hospitality really sticking out, creating more, about 128,000 jobs in the month. That is a huge gain, but maybe not surprising, Brad. We got some really good earnings results from these airlines, and all of the commentary that we heard on forward bookings into the spring was pretty strong. So clearly, at least that sector is not preparing for an economic downturn.
Yeah, the travel leisure space has been talking about a golden age of travel since October at this point, and for some of them signaling that demand that was holding strong even since the summer of last year. So where does that put us now as it relates to the employment situation here? If you're going to continue to see leisure and hospitality try to rebound as best as possible, and it is doing so, largely has been outpacing because it's, in the job gains at least, largely because it's had the farthest way to come back, then where does it get into some of the other elements of the economy? In those consumer discretionary sectors, that's one element that I would continue to watch out for here. When you have companies that are, they've got these large, massive storefronts and footprints, and they're saying to themselves, okay, do we really need to hire more workers right now, or can we just reinvent the retail experience? And especially in some of those categories that aren't performing well, why would they be compelled to open up more jobs? And at the end of the day, does that mean that for some of the employees that are there, perhaps they'll get paid more, but that doesn't mean that they're going to have a lesser load in their workday as well.
I really like what Joe Bersuelo said about why these tech layoffs are not showing up in these jobs numbers. The headlines on jobs hasn't been good, notably from tech, but also increasingly manufacturing. He said they're still getting hired. They may not be getting hired at the same rate, but this pool of employees, a lot of smaller companies have not had access to them at lower wages or had access to them at all. So maybe they're getting hired right away.
If worse comes to worse and you're a coder and you get laid off, you can always go work on a cruise ship. They're looking for people.
Or create your own business.
Sure, exactly.
I don't do cruise ships, so I find it hard to work. But hey, more
You can work
power
in a
to you.
hotel. You don't have to. It doesn't have to be floating.
That's true. That's true. There's a lot of good hotels.
Be sure to take Spirit on your next cruise.
What's that?
Take Spirit.
Oh, no, never. Guys, second thing you need to know, that's the last thing I need to do is be on a yellow boat. Anyway, and the second thing that you need to know today, Apple shares in focus following a miss on the top and bottom lines. Tech giant failed to meet expectations on iPhone and wearable sales. Joining us now to dive into the number, we've got Jim Suva, City Managing Director in Equity Research, specializing in technology. Jim, you were on Apple's earnings call yesterday. You got a chance to lob some questions into Tim Cook. Brian and I gave our vibes and our vibe check after the call. I want to know the vibe that you took away from what Tim and Luca had to say.
Hey, it's great to see my friend Brian and Brad and Julie all on the show today. Importantly, the big takeaway is this. Foreign exchange has materially hurt Apple. And then the second negative was the China COVID production close down. When you remove all that and take a step back and look at the big picture, Apple subscriber user base is still growing. The number of active devices which are being used is now over 2 billion with a B. And the number of iPhone users is over 1.2 million. And so we're really looking at this really important way of things being set up here. When we look at, again, the active number of devices, it's actually 2 million. I said 2 billion, but 2 million. I'm sorry, it's 2 billion with a B. And important to note that these are actively users that are using subscribers and service and all that. But the takeaway is FX hurt. And let me quantify you that. 8 percentage points of FX hurt in the December quarter and 5 percentage points in the March quarter. If you remove all that, Apple is still growing in reported terms. And importantly, their subscriber base is growing. This is important. This is why we're sticking with our buy rating and $175 target price as you're showing it correctly.
So, Jim, okay, if FX was largely to blame here, I think of Apple as typically managing all of this better. And I don't just mean managing its currency hedging. I mean managing you folks, managing the analyst community, right? I mean, in terms of managing expectations. Is that, like, what happened here on that front?
Well, importantly, since COVID hit, Apple has stopped giving forward quantitative guidance. They've given more color on the conference call. You heard that Luca, the CFO, and Tim gave some color or some qualitative guidance.
Is that a bad decision, though? Is that a bad decision given what we're seeing today? Does Apple need to bring that back?
Julie, in a world where we have unemployment challenges, FX challenges, supply chain challenges, I don't think it is. I don't think anybody has a crystal ball right now. I think giving less guidance right now is fine. When the visibility comes back, then we should expect some more. But for right now, the qualitative guidance was just fine. And then on the callbacks, it's important to note that people start to be able to ask some more pointed questions. But simply put, numbers are coming lower, but it's mostly due to FX and the production issues. Look, the problem is Apple can't supply enough. Demand is here and supply is here. That's a good problem to have when demand is way above supply.
Jim, hang with me here. I'm going to plug myself. The most read story on Yahoo Finance right now is one that I wrote this morning. Apple stock gets nailed as CEO Tim Cook spooks investors with one phrase. Now, if you click through, that one phrase is challenging economy. Cook and his CFO mentioned it seven times on that earnings call last night. How concerned were you about their commentary on the global economy, and how would a recession impact this company this year?
So first of all, that's a very well-written article. So
well, that's why I'm here. That's why I get those big checks, Jim.
But I can tell you this, the economic uncertainty, look, you look at the Fed interest rates the other day, you look at the employment data this morning, and you're getting a lot of data points that are coming in that aren't all on the same page. You have inflation, you have clothing, housing, gasoline costs that are going higher, natural gas that are going higher. You're going to get hit with a big freeze in the New York area this weekend, and people are going to turn on their heaters a lot. There's a lot of costs and dynamics that are changing. It's a very fair and honest way to assess things, and I think that's why people are reading it.
And so if you were an investor looking at Apple today trying to evaluate if this is the time to get in or if you should be waiting for another shoe to drop, what do you say to that investor?
I think you should buy the stock here. And the reason why is the world is getting past some of the COVID closures, the worst, the death, the illnesses, the how society reacts, the worst of it's getting behind us. Production is coming back on. The supply chain bottlenecks are getting better. And Apple is continuing to innovate. You know, we expect them to launch an AR, VR headset later this year. We expect them to have a foldable phone next year. I think that foldable phone will be great, where you can on the top look at Yahoo Finance and on the bottom be reading your emails. I think that will be a great phone to have. They're working out some of the kinks on it. That will be for next year. But the reason why that's important this year is people will start to look ahead to say, hey, where's the innovation? The innovation is still coming there. We think it's a great opportunity to buy the stock on this little bit of a pullback here. The pullback's not been big, but Apple's high quality.
Jim, but why launch unproven products at a time where consumers are already pushing back and the discretionary spend is souring?
Well, when you think about unproven products, first of all, we're talking about late this year, and come the Worldwide Developer Conference in June, they typically focus on software. When you think about a VR, AR headset of taking a picture of your showroom, of your kitchen, of your dining room, and reinventing it by moving things around virtually, there's a real business case application. It's more than just gaming. It's education, doctors, nurses, different pilots and fields that can be educated. We think it's pretty exciting. But right now what matters most is iPhone and the company's subscriber base, and they are growing.
I don't know. I'm looking forward to looking at Yahoo Finance on the top of my folding phone.
Me too, and we work here. I'm so excited.
City Managing Director Jim Suva, thanks so much for your perspective this morning. Really appreciate it.
Thank you. Keep warm this weekend.
Will do. Thanks, Jim. Well, the third thing to know this morning comes from another tech giant reporting earnings. That is Amazon. The company announced a mixed bag for its fourth quarter. Total revenue came in above expectations, but missed when it came to online store sales as they were hit hard by a consumer slowdown. We're going to dig into it more later as well, but the cloud unit, AWS, saw slowing growth. That was also a problem. But I am intrigued by what is happening at the online stores as well, because a lot of the analyst commentary I saw, a lot of it was positive, even though we saw that weakness in online store sales that came in below estimates. Most of the analyst commentary I saw said it held up pretty well. There were a couple who said it didn't. Yeah. And so I'm like, these people are all looking at the same numbers, and yet the interpretation was quite different for, in particular, that 2.3% drop.
Yeah, I just think if you're trying to get a good read in on the consumer and trying to look across where products are being taken on by individuals and households, you can look no further to Amazon's miss on this online segment, selling less than expected, and the $64.53 billion compared to that 65, so slight miss there. And then you want to draw a through line, another one that's supporting data from Apple as well, miss on product there. And so consumers right now are being extremely value conscious about how they're spending their dollars and where they're spending them, even if there are deals to be had on the deal factory that is Amazon and the Prime membership as well.
And since it's Friday, I'll touch the third rail. Let's not lose focus on the fact that Amazon CEO Andy Jassy was on this earnings call. Now, he mentioned on the call yesterday, just past his 1 year mark, that he also noted that he will likely try to hop on the earnings calls a little bit more. I think Andy's starting to feel some pressure. The stock has not done well under his leadership, whether if that's just the COVID unwind, whatever it is, the stock has not been doing well. The capacity that in many respects he helped build during the pandemic, it worked then, but now they're having to unwind it. They're having to lay off workers. I think he's facing some increasing heat, as he should.
I mean, on the flip side of that, the stock, like the rest of the tech sector, has rebounded this year. It's up 34%, so it's right in there. It hasn't really lagged competitors. And again, when you go to a couple of other bright spots here, when we talk about, when I was mentioning that analysts are more positive on the retail sales, Brian Nowak, for example, over at Morgan Stanley, mentioned a steep improvement in retail profitability. So even though the revenue might have missed, maybe profits in that in that area are going a little better. One other thing that stood out to me, physical stores, i.e. Whole Foods,
Love Whole Foods,
came in above estimates, up 5.7% at $4.96 billion. And that's a group that has not necessarily been working so well.
You know, I'm excited about Whole Foods. I just found out recently they do $1 oysters on Friday. I had no idea this was even happening.
You've been touting this to me.
I thank them for doing this. So, you know, obviously that's probably an operating margin hit to Amazon, but, you know, I'm okay with it.
So we know what you're doing tonight.
That's what I'm doing.
Selling $1 oysters at Whole Foods, though, that gives you a sense of the type of consumer that they're continuing to go after. The consumer that says, all right, whole paycheck, no problem.
Well, you can't get any because you have to be a Prime member. No, I'm just kidding. Actually, they're free.
Well, you know what?
Not free, but they're not.
Italy, you got me.
So here's the big question before we leave it.
I'm eating them alone.
That was going to be my second question. The biggest question is, do you pair them with champagne or vodka? Which way do you go?
That's a good question. Might be a Red Bull tonight. All right, thanks so much, Julie. Straight ahead,
That's not
Starbucks
the right
shares
answer
are
in
under
any world.
pressure after a tough quarter for China. We'll dive into the results with Starbucks CEO Rachel Ruggieri next. Starbucks shares are under pressure as investors lock in on a disappointing quarter for China sales. That focus is overshadowing a good quarter for Starbucks U.S., fueled by demand for holiday drinks and egg bites. Let's welcome back Starbucks CFO Rachel Ruggieri. Yahoo Finance's Brooke DePalm is here as well. Good to see you both. Rachel, of course, I'll start with you. Let's lock in on China here. Have you started to see any sales improvement here out of the country as more locations have opened up?
Yes. So we've seen improvement in the month of January, and I had shared that on the call. So we're encouraged by the signs of improvement that we're seeing. We still believe there'll be some headwinds in this quarter, but we're expecting to see more tailwinds in the back half of the year as full recovery starts to take place, travel increases, and people can get back, more to normal day-to-day routines. And so we're looking forward to that because it's going to help with our overall, what we had provided was reaffirmation of our guidance for full year, and China will be a big part of that.
Rachel, within that guidance, that reaffirmation, do you see China sales growing again in the back half of the year?
Yes, we see China start to grow and contribute meaningfully in the back half of the year, and that's supporting part of our reaffirmation of the guidance, but it also gives us good confidence in the long-term growth targets that we've alluded to.
And here in the U.S., same-store sales were better than expected, but we're down after 2 p.m. Do you think that high inflation and recession fears have caught up to the U.S. consumer?
You know, I would say we don't see a challenge in our demand today. And in fact, what we're encouraged by is our reinvention plan is going to allow us to unlock even further demand. So we're working on being able to unlock the capacity in our busiest day parts. And so we see the opportunity to continue to service even more demand in the periods where we're busiest. And that's really the proposition that we're going after. So I would say demand is just coming to us in different ways.
And here in the U.S., how much did Starbucks raise menu prices from this time last year? And do you expect to raise prices in the first half of this year once again?
The increase that we're seeing in our ticket related to pricing is annualization from pricing moves we took last year. Our pricing was taken largely in line with our inflationary pressures. So this year, the ticket is benefiting from the annualization of that. When we comp that in the back half of the year, we'll start to see pricing return more towards historical levels. And so we'll see a moderation of our ticket and an increase to our overall transactions. So we've guided a comp range of 7 to 9% in the U.S. business, but you'll start to see more of a balance between ticket and transaction.
Rachel, given the economic concerns here in the U.S., do you have anything baked in terms of more promotions on the app or more promotions in general to get people back in the restaurants in the afternoon?
You know, the reality of it is, while we understand that our customers are dealing with a lot of uncertainty and economic challenges, we aren't seeing an issue with our demand today. And so we're not planning on discounting or moves of that nature. We continue to grow our rewards program, and that creates value for our customers. We increased in the quarter by in the U.S. business, we grew by 15% to 30 million members. That's up 4 million versus prior year and 1.7 million versus the prior quarter. So that speaks to the value that it creates for the customer, and also it's good for our business. So we'll continue to lean on aspects of our business like that to be able to bring more customers in and to be able to provide them with the value that they're seeking.
And the Starbucks Rewards update is getting a lot of buzz among Main Street, Wall Street. How exactly will this boost margins for Starbucks? But for the main consumer, what does this mean about that Cafe Misto hack that they are grown to love?
Yeah, I mean, I think the reality is, you know, we're trying to ensure that we're able to continue to grow the program while we create an efficiency. We've taken pretty significant pricing moves over the past couple of years in line with the inflationary pressures. So it's important to make sure that our product redemption aligns with that. But we've also, through the changes in the rewards program, offered value for customers in different areas. For an iced coffee, for example, now they can have a contribution or attribution in terms of earning stars towards iced coffee. So we've been able to take some benefits in the program to allow some members to be able to choose their favorite beverages and earn along those lines. It will help support our margin proposition in the future as well as our revenue growth. So overall, we see it as a good driver to our business, but also still provides value to our customer.
Within the various costs on your income statement, Rachel, do you see disinflation?
We don't today see a material impact from disinflation. We did see a slight easing in terms of coffee costs and non-coffee commodity costs, such as plastics. But then we saw an increase in terms of our overall logistics. Part of that is due to demand, but it's also a fact of that there's still challenges across the supply chain. So broadly, we're still seeing inflation at an elevated level in FY23, not as high as FY22, but it is still elevated.
You've invested a lot into labor, wage and benefits. You had the highest turnover, or rather improved turnover rate since Q2 of 2022. Where do you think labor for Starbucks stands right now?
You know, we're in a good position today, and we believe that's because we've invested ahead of the curve, and we're continuing to make investments. Part of our reinvention plan, right, is to continue to roll out equipment that creates efficiency in the stores, to create a better experience for our partners as they're serving our customers. We've leaned into increased training. We've leaned into better wages and benefits. The combination of that has helped us so that we've been able to bring turnover down and, importantly, improve retention. It creates a more stable environment, which is good for our partners, but it's also good for our customers.
And Rachel, on the call last night, Howard teased some form of something new called alchemy. And I appreciate you probably can't say much about it, but Maybe you could just narrow it down. Is it a new restaurant concept? Is it a drink? Is it a food? Is it something that Howard is just working on separately once he steps aside as CEO in a couple weeks?
Well, what I can say, I can't share much about it, but what I can say is it leads to innovation, which I think is an area we've always played well in at Starbucks. We've always found ways to try to surprise and delight our customers, and this will prove to do something in that fashion. And what it does is ultimately, you think about today, part of our proposition is you have to come into the stores because so much of what we make, it's hard to make at home. This is another way to lean into that area, give customers a reason to come into our stores, and importantly, a reason to come back.
All right, well, if it's a drink or food, I'm likely a buyer. Starbucks CFO Rachel Ruggieri, always nice to get some time with you, and thank you, of course, to our very own Brooke DePalma.
Thank you.
Coming up, Nordstrom gets attacked by a meme king. More on this next.
We are less than a minute away from the opening bell on Wall Street, and it looks like it is going to be a down one in the wake of the jobs report that we got this morning. The Nasdaq showing a decline of 2% at the open, of course, adding insult to injury. The big tech earnings disappointing, and they are trading down as well. So all that combining to make the Nasdaq the worst performer of the three majors. If you look at the pre-market trade here, S&P futures also pointing to losses, as are Dow futures here this morning. And guys, it's very interesting what we're seeing here and what we're hearing from investors, because many of them don't seem to be reading the jobs report necessarily in as dramatic fashion as the market reaction would make you think.
Yeah.
Well, no, is that Susan Lucci, I think, up there?
Well, it's Star Jones up there for sure.
All right, cool. All right.
American Heart Association, I guess.
Oh,
some,
very cool.
Some prominent folks who are pulling for it. And that is
awesome.
Lucci. Look at that.
Yeah, but again, non-farm payroll is up 517,000, Julie. Good.
Did you say 917?
517. 917. Wow, that'd be. Well, you know, I'm not surprised. I'm checking my fitness tracker right now. My heart rate is 140 beats per minute, guys. So, you know, I'm a little fired up today. It's been a morning. Brad, over to you.
We're fired up today. Brad?
is that working?
Well, the markets are also fired up and in the wrong way here on the day here. Let me just get this over to the right part. It looks like somebody may have been looking at some other data here a moment ago. But we saw there on the screen there, and you've got it in the lower corner of your screen for our folks at home, Dow Jones Industrial Average opening lower by a fraction of a percent, by about 0.3% there. And over the past 3 days, net lower here. The Nasdaq Composite, depending upon how we end today, and that's going to be largely in focus, because considering the week that we've had thus far here, taking a look at the past 4 days, we've been higher by about 5% as of right now, lower by 2% here. And we've had some earnings that we've been bringing to your attention both yesterday after the close and this morning post some of the earnings calls as well that took place last night. Well, the Nasdaq Composite tech heavy average, that's down and reflecting some of those declines by about 2% right now. S&P 500, you're seeing that down by about 1%. Wouldn't be surprised if we had the worst performer in the S&P 500 11 sectors being technology. And here on the day, well, it's not. Technology is not the worst performer. It's down by about 1.5%. But then also you've got some move lower in consumer discretionary. That's down by about 2.7% here. And then communication services, that also seeing a leg lower of about 2% this morning. Only three sectors in positive territory right now, Saz.
All right, let's get back onto the big tech earnings theme. Qualcomm wasn't immune to the broader tech slowdown in its most recent quarter, with sales dropping 12%. Operating profits were also under pressure. Really, this quarterly weakness driven by pressure on the handset business. That is, of course, things we've seen in the likes of Apple last night as well. iPhone sales under pressure as well. But Citi saying this is a difficult time in handsets. And if you take the handset business and the Internet of Things business for Qualcomm, that makes up about 77% of their fiscal first quarter sales, what they just reported.
Yeah, and that's something that investors are looking to more and more. And the company has really touted more and more is outside of the handset business, what else is working? Initially, the Qualcomm shares actually went up after they reported their results. Automotive sales were up 58%. You mentioned connected devices, I believe, up 7%. However, if you're thinking about the overall revenue of the company is $9.46 billion. Automotive sales is $456 million. Connected devices is $1.68 billion. In other words, yes, those areas are growing, but they're still very small as a proportion of the total company.
As compared to the in excess of $5.7 billion for the Q1 fiscal 2023.
For the handsets, yes.
Handsets, yeah, exactly. And so, really thinking about how they continue to not just move more into the automotive landscape, or at least kind of lessen the dependency on that handset business, knowing how much Apple, how much Samsung, how much some of the other manufacturers have proven that they are ready to throw their weight around and perhaps have a little bit more vertical integration. That's a red flag for Qualcomm right now, at least. And so just a larger question of where you continue to have that demand generated in this near term as well, given the shift that you've seen from some of those large historical purchasers from the business too.
Another mover that we are watching this morning, meme work makes the JWN dream work was the title of our friend Simeon Siegel's note on Nordstrom after activist investor Ryan Cohen reportedly garnered a sizable stake in the company, intending to urge a shakeup in its board. He set his sights on replacing former Bed Bath & Beyond CEO Mark Tritton, in particular, on the board of the company. This, according to multiple reports, was first reported by the Journal, but I know you've confirmed this news as well, Mr. Sazi. I don't know what he thinks he's doing. It's a family-controlled company. And there have not been too many activist attempts at family-controlled companies because the family controls the company. So I'm not quite sure. They've said that they're willing to work with him, yada, yada. I don't know how this is going to play out.
So Ryan Cohen has taken a position here, a source tells me. Now, Nordstrom is responding that they have, in a statement to Yahoo Finance, they've not had any, Mr. Cohen hasn't sought any discussions with us in several years. And, this goes back to, my long-running thesis on Ryan Cohen. It's unclear what he's trying to do with these companies, because what he did at Bed Bath & Beyond was essentially squat. And I don't know what his plan here is here with Nordstrom, but if it's anything like what he did at Bed Bath & Beyond, it's probably no plan. And it's just, I will say this though, Nordstrom shares down about 45% over the past 5 years. Down even more, of course, before this move by Cohen. There are opportunities, I think, for Nordstrom either to, let's say, spin off their rack business from their full-price stores and also improve operating margins. Now, for all the great customer service that Nordstrom offers, and the street loves the brand for that, it's come at a cost. They've invested millions upon millions of dollars in developing the services they do have, buy online, ship from store, you name it. But it depressed margins, and there's a vibe that they could and should be doing better. But again, to your point, Julie, this is family controlled. Ryan Cohen's track record here in terms of true activist investing, Nelson Peltz, he is not, is wildly unproven and wildly unclear. And I just don't see what he's going to get done here.
You know, I think on Sunday I'm going to pray that God give me the confidence of a Ryan Cohen to go in and try to have all of these turnaround stories when really my only proven thing perhaps has been in the pet category. This is a different type of shopper that you're going after.
GameStop?
GameStop, unproven.
That story's getting worse?
GameStop, unproven. You've got a potential Nordstrom play here, unproven that he would be able to make a major wave in a very affluent, consumer-driven retail environment and experience as well.
He's been dead wrong about GameStop. That fundamental story has gotten worse over the past 6 months. He's still on that board. He was proven, I think, wrong on Bed Bath & Beyond. He essentially did nothing there. And I think this has now just become personal for Ryan, where he just wants to attack Mark Tritton. He just does not like Mark Tritton. And I can tell you, Mark Tritton doesn't like him.
All right. Well, let's also talk about shares of Ford here on the day. Ford shares have been driven downward following its latest financial results as fourth quarter and full year 2022 operating results came in below its expectations. The automaker also suffered a full year net loss of $2 billion. Ford citing its lackluster performance in parts to execution issues in an environment with supply chain and production instability, resulting in higher costs and lower than planned volumes. It was a challenging environment for vehicle sales over the course of 2022, no doubt. Ford also reclassified the way that they wanted investors and they wanted their financial results to be really proven out over time and breaking out. And this was earlier last year, actually this time last year, that they had done so. So now the larger question on some of the comps that you've now created, where are they going to show that demand is coming back into the table? And for all of the different equity plays that they have across their vehicle lineup, all they're doing is saying, hey, it's electric now. So that Mustang, that Mach-E, which has done well, it's electric. Or that Hummer, well, no, that's GM, sorry, Ford. But at the end of the day, the F-150, the Lightning, trying to make sure that the cars that have been doing well for decades at this point can have the same type of fanfare on an electric basis.
Jim Farley, CEO of Ford, no question, has rejuvenated this company. All these electric vehicle products have been out under his watch. He has done a good job. But now he has to take things to a next level. It's not necessarily just he can come out here with these amazing new electric vehicle models and excite Wall Street. He has done that. Now I think him and his team and CFO John Lawler are trying to dig into every part of the business operationally and structurally. Of course, this is a legacy automaker. This is not like a Tesla that was built, a decade ago, and they were able to start in doing new processes from day one. I think for them, they have to fix a lot of the structure of the business, and in doing so, they're hoping to take out a lot of costs. But at the end of this week, take a look at these two different stories we have heard between GM and Ford. GM CFO Paul Jacobson came on with me early in the week, said, Brian, we're cutting $2 billion in costs this year. You have a Ford now only trying to find cost savings that they might execute upon. Mm-hmm. Two totally different stories exiting this week.
It's sort of a flip of the stories as well.
Flip the story.
Yeah.
Because it was the opposite before.
Right.
In terms of how they were doing. Anyway. All right, coming up, the search for disinflation. Sas is going to break down his take on that keyword, buzzword, next. Fed Chair Jay Powell surprised investors on Wednesday during his press conference, noting that disinflationary process has begun. Investors took that to mean fewer rate hikes real soon and potentially higher stock prices. That sent SARS in search of disinflation in corporate earnings calls. The script has flipped a little bit today. The narrative's changed a little bit today.
That's me looking for disinflation.
But what we're hearing from companies has not changed. Like, even jobs report aside, companies are still talking a lot about prices.
They are, and look, we just talked to Starbucks CEO Rachel Ruggieri moments ago, and we asked her if she's seeing disinflation in her items. No, still seeing high levels of inflation. But ultimately, I think at first it is important to break down what in the world disinflation is, because it is not deflation. So here is disinflation just decoded. It's used to describe the slowing pace of inflationary pressures. Look at it another way. It is a decrease in the percentage change in inflation. It is not deflation. So very important thing to just point out there and consider as you're starting to hear these disinflation discussions pop up. Now, where we might be seeing some disinflation here, I went through a couple of earnings calls from this week. Going to start with Brinker CEO Kevin Hochman on his EPS call. He came on here on our network yesterday, talked about the turnaround at that brand, saying that commodity inflation for the quarter increased meaningfully year over year and will continue to be a headwind, although at a diminishing rate as we move through the rest of the fiscal year. To me, that smells like disinflation. Next up, Otis CEO Judy Marks. They reported earnings this week. I talked to her on the phone. She said, we see commodities have already become tailwinds in China. We saw that last year. They've turned now in the Americas, but they haven't turned yet in Europe. I would also call that some disinflation. And the McCormick CFO Mike Smith on his earnings call. McCormick, of course, the maker of some amazing spice that you probably rub all over your fishes and meats. The impact of cost inflation will be weighted toward the first half of 2023 with peak inflation in the first quarter. So maybe some disinflation at the likes of McCormick and some of its competitors. My take is this, and it's something to keep in mind as we talk about this more. Not every company is seeing disinflation, so be careful, bulls. Like I just mentioned, Starbucks CFO Rachel Ruggieri still warning investors that inflation remains high, and in some line items for them, they're just not seeing costs come down.
Disinflation after they had to do a period for some of these retail companies of discounting or price normalization again.
We could all use a price break at this point. It's been about 2 years of rampant inflation, double-digit increases. Get us some disinflation.
I mean, to your point, though, about people being careful, I mean, some of the consumer products companies, for example, Colgate-Palmolive said prices are still going up. Yep. So you definitely have to pick and choose on that front.
So true.
Coming up, a soft landing may be priced in, but that doesn't make it likely. Yahoo Finance's Jared Blickery going to break down today's morning brief. That's next. So investors seemingly took a glass half full approach to this week's Fed decision and press conference from Fed Chair Jay Powell. Despite more rate hikes on the table, the general response was relief that disinflation was the word of the day. But are hopes of a soft landing premature? Writing in today's morning brief, Yahoo Finance's Jared Blickery says this soft landing has the holy grail for the Powell Fed, an economy in which inflation comes back to target and doesn't tip into recession. Jared joins us now to talk about Goldilocks. Jared, take it away.
I hate to disappoint everybody. I don't think it's coming. Even Powell doesn't think it's coming. If you paid attention to what he was saying Wednesday, he was banging the table once again, saying that he's going to raise rates. It's going to be higher for longer. And he doesn't believe that a soft landing is a base case. What he said was some analysts believe that's a possibility. He thinks it's a possibility, but that doesn't mean that majority opinion rules here. Now, Nasdaq is down 1%. I'm going to show you the 3-day here. I thought it was important to look as a potential reference point because given the strength of the payrolls number, some people would say, well, a good news report is actually a bad news report for the market. So we did see this initial sell-off, but we are right back up to the starting point there. So I didn't tweet this morning, but I did say to a few people here, if we close green on the day, that's going to be very bullish for stocks because you look at the longer-term trend here, we have just broken out to the upside. We have a series of higher lows and higher highs, so could be bullish for stocks. Now, I want to get back to the jobs report because a few interesting trends here. I was noticing that construction jobs on a year-on-year basis were actually going up. And it's at this stage before a potential recession that you would expect that to be going negative. Instead, it's going positive, and it's already positive to begin with. So when we see the job losses, we see them initially in startups and high growth. We've been reading those headlines, manufacturing, construction, wholesale trade, and then we start seeing it bleed into the other sectors like retail, financial services, professional service. And then later on in the recession, we finally see decreased spending habits hit the leisure and hospitality sector. Those people are laid off. Same thing in information, which includes us in the media as well as software, mining and lodging, kind of its own thing, education and health, government and utilities. Now, government, I should also say, saw a big increase in payrolls, and that was because of the effect of university workers who had gone on strike coming back into the market. So between that, education, and that's part of the university thing, and also construction, that's where we're seeing a lot of these outsized gains. I think it's been really important to see if that changes. Now, in terms of construction, there are so many commercial real estate projects going on right now. They are making up for the lack of construction in residential retail or residential construction, and that overhang, that is expected to change in about the middle of the year. So we could see these construction numbers increase over the next few months, or at least stay the same, and then roll over. Anyway, none of this takes away in this jobs report the potential for a soft landing. In my opinion, I think a soft landing is even less likely than it was on Wednesday.
Very interesting. And as you mentioned, that is not what the market is currently pricing in. So we'll see who ends up being right. Jared Blickery with the Morning Brief. Thank you so much. Appreciate it. So is this a soft landing trade? Is the market right? Or has the January jobs report changed the landscape in some way? BlackRock says it sees the market and central bank disconnect resolving and favoring higher rates. Joining us now to break that down is Wei Li, BlackRock Global Chief Investment Strategist. Wei Li, thank you so much for being here. So, given what we just heard Jared talking about, given where the markets are, given what we heard from the Fed and the jobs report this morning, there's a lot buzzing in our heads, obviously. What do you think is the likelihood of that soft landing scenario at this point?
Well, if we look at market pricing so far this year, it's not even pricing in soft landing. It's pricing in takeoff, right? It's pricing inflation to come down. It's pricing growth to avoid a recession altogether. It's also pricing in central banks cutting rate starting mid this year. So that is really markets priced for perfection. And in the near term, beyond FOMO and chasing momentum, it's hard to see a fundamental reason for stocks to keep pushing higher. You talked about the very strong labor markets. Indeed, I mean, like we always thought that labor market is very, very tight, but even this number is higher than our expectation. Maybe there are some seasonality factor at play here, but the bottom line is that the effect of the over-tightening by the Fed have yet to be felt by the labor market. And that means service inflation is likely going to be persistent. Core service inflation ex shelter is likely going to be persistent because of the wage component. And that means actually interest rates, yes, they will peak and they will pause, but they won't be able to start cutting rates this year, which is also why we're currently underweight developed market equities. We prefer emerging market equities because of global dynamics with China reopening. And in fixed income, we want to stay in high-grade credit for their income potential. And we also like front end of the government bond market because of the income potential.
Okay, so that starts to get into what my question was, because for a lot of investors out there, their New Year's resolution was just simply in 2023 not have the same type of losses that they may have had in 2022. And so now for them, what is the disinflationary environment portfolio playbook that they can enact and strategize?
Well, if you believe that we're in an environment of disinflationary, inflation falling down very, very quickly, not only to 4%, 3%, but all the way to target, then it's an outright risk-on type of playbook, which is essentially what markets have demonstrated so far this year. But because of our view that it's easier for inflation to get to 4% just from goods service rotation along, but to go from 4% to 3% and below all the way to target, then we're talking about the sticky components of inflation related to wage, which is hard to actually see that transpiring, which is why we wouldn't kind of chase this momentum at this juncture. I would say, though, to your point about everyone starting the new year wanting to avoid the sort of performance that we saw last year, there is a lot of cash being deployed to participate in this rally because of FOMO, fear of missing out. And I think that explains part of the momentum that we're seeing, and just in addition to short squeeze that we have seen some signs of as well.
And alongside these jobs numbers today, we have earnings season still going on. Tech, of course, wrapping up. What have been some of your biggest takeaways?
Well, we're actually seeing signs of margin pressure coming through, right? So we're seeing sales growth outstripping earnings growth, which is the result of margin coming under pressure. Expectations have already been lowered, and yet beats is below historical average. So we're actually seeing what we would expect from earnings, but that's not being listened to by markets. Like even the misses are being rewarded with positive return on the day of the earnings release, which means that the attention is focused elsewhere. It's focused on inflation. It's focused on central banks, not so much on the fundamentals. But at some point, as technical factors wash out, focus will shift back to fundamentals.
Are the fundamentals bad for corporate America?
At this juncture is not going to be as good as what markets are pricing for. We are expecting a mild recession. We are expecting a mild earnings contraction around a -6% for S&P 500 versus currently markets pricing in high single digit for earnings growth. So we're not expecting a very, very bad outcome for fundamentals, but currently market pricing is very good, and that's where the disconnect is.
Some execs have tried to pivot the attention towards their international business and primarily looking at some of the potential rebound or the growth in India and China particularly, which kind of mirrors what we had heard from the IMF. But is that enough in that kind of global picture to buoy them or offset some of the declines or near-term headwinds that they might see in the U.S. and EMEA?
Well, if you look at how oil price has performed, it's fallen a bit, but it would have fallen a lot more if China restart didn't pick up momentum as we saw so far this year. So this theme that you talked about in terms of pivoting towards international market is also how we see our equity allocation currently playing out as well. We see U.S. equity markets being kind of priced for perfection at this juncture. International equities look more interesting. Emerging market equities look more interesting, especially given the context of a weaker dollar after last year as well, and also the fact that, yes, we see recession, but it's a mild recession, so we can move on and move through it.
Always great to get your insights. Wei Li, BlackRock Global Chief Investment Strategist. Have a great weekend. Stay warm.
Will do. Thank you.
All right. Today's unusually strong jobs report, dashing hopes of a dovish Fed. This even after less hawkish Fed remarks and major earnings, all within the span of a few short days. Let's get a broader look on where the economy is headed. Marty Walsh, U.S. Labor Secretary, joins us now. Mr. Secretary, always nice to get some time with you. Your top takeaway off of this report?
It was a good, strong report, certainly far better than expectations. And when you look at the unemployment numbers and the rate, 3.4% unemployment rate, the the lowest since May of 1969. The black unemployment rate, 5.4%, the second lowest ever recorded since the 70s, that when we started recording those numbers. We've seen strong gain in business development, business and in hospitality and leisure, and certainly in healthcare. So, it's a good, strong report. It shows that, 12.1 million jobs have been added to the economy since or created since President Biden has taken office. So, it's good momentum.
It is good momentum, Secretary Walsh. It's Julie here. And what do you expect that momentum to continue? What do you think happens from here going into 2023? How are you sort of thinking about the year and preparing for what we're going to see in the job market?
Well, I think, certainly this number jumped off the page when we saw it, and it was a big number. I think that, you think we saw labor participation rate tick up a bit. There's still many openings in the United States for jobs. So I think that my focus will be making sure that we get that participation rate up even higher, getting more people into jobs, whether it's training or apprenticeship or workforce development. So there is real opportunity here. We talked about a little bit. I've talked about it for the last year on this call, on this interview, I should say. I think that some of the policies that we laid out there, the CHIPS bill, the infrastructure bill, the IRA, those are going to create more jobs as well. I mean, some of those jobs might be replaced from other areas that are slowing down, but I think there's real opportunity here moving forward.
We've talked about those jobs that are going to be created and kind of classifying them as good paying jobs that would allow people to earn a living. And for the environment that people have had to navigate through over the past year and change, it has been one where prices are higher for everything from the necessities to all the way through the services that they choose to pay for as well. And so when you think about that target of what a good paying job is, how does that change within the administration, perhaps even quarter over quarter at this point, so that people do have the opportunity to kind of maintain the ability to save and earn a living as well?
Yeah, well, I think first and foremost, we've seen wages grow 4.4% year over year. Inflation is roughly 6.4%. So I don't think it's just about closing the gap between wages and inflation. It's about creating a pathway for families to be able to get into the middle class, buy a home, buy a car, keep food on the table, and be able to have a little bit of money in the bank, savings. So I think that's when I think of that, that's what I look at. It's not just simply closing the gap. And 2 weeks ago, I was in Switzerland and Austria, and I was looking at the apprenticeship programs there, and not just looking at the programs laying out, but really about the opportunity for middle class. And I think that we just have to continue collectively to work together. I think Congress made a determination over the last 2 years to make major investments in infrastructure and other things. I think what we're going to do now is capitalize on those investments. So it's not just about closing the gap between inflation and real wages and year-over-year earnings. It's about making sure people have long-term sustainability into a job that they can be proud of and allow them that opportunity, as President Biden said, build an economy from the bottom up and the middle out.
Mr. Secretary, when you travel around the country, are you just surprised that so many folks in the markets are talking about a recession? I mean, do you see any signs of recession in the places you travel to?
No, I kind of, I said a long time ago, I think this economy and what we're experiencing right now is very different. It's hard to put into words, and I think economists are trying to figure out how to put this into words. And I think that we just have to keep signs on making sure our construction markets are strong, making sure that when you have conversations around the tech sector laying people off, you want to see if that's a short-term or is that a long-term problem. And again, just monitoring those and responding. And in 2021, when the president took over, he laid out a plan to get people back to work. In 2022, the beginning of the year, he laid out a plan on inflation because that was a big issue on rising gas prices. And we stayed to those plans. And I think that folks at the White House and working with the private sector have done a really good job of trying to identify a challenge and addressing those challenges.
I'm glad you mentioned some of the layoffs within the tech sector, Labor Secretary, because when we think about the reason that's been given by some tech companies, it's because they're moving towards solutions that are more artificially intelligent and to increase productivity from their perspective. But I wonder from your perspective whether or not artificial intelligence, if AI is a threat to some of the employment situation goals more long term.
I don't know how much. Obviously, it's somewhat of a concern in employment goals. Obviously, I can't say it's not. But I think long term, I'm not sure. I've heard a lot of different reasons why, or several different reasons why the tech sector is making layoffs. I think that it's kind of a watch and see approach as you move forward here to see what happens. I think in those tech sectors, you still need people. You still need people invested in those areas. And I'm not sure how much artificial intelligence. Maybe in the long run, there'll be a lot more artificial intelligence. I think in the short run, you're still talking about you need a workforce. But again, I think I'm always of the mindset. Let's not panic about modernization. Let's try and work with it and see how we can move forward with it.
And finally, Mr. Secretary, there's starting to be a little bit of turnover in this White House. Brian Deese, for example, just confirmed he's going to be stepping down. There are some reports. I can't imagine you're going to comment on this, but I got to ask you about it anyway. There are some reports that you've been approached to head up the NHL Players Association. Are you getting antsy there at all? What are your thoughts on this year and whether you're going to be sticking around?
Well, I can tell you, I'm not going to make any personal news today. And I think that when I think about the job I have and other folks in the White House, where they have, people have been working really hard for the last 2 years on behalf of the American people at the direction of President Biden. And this job that I'm in today. Certainly is something I would never have imagined in my life, never mind 2019 and early 2020. And when the president called me and asked me to be his labor secretary, I left a job that I love, being mayor of Boston, to serve not just the president, but the American people. So I love my job, and I like my job, and we'll see what happens in the future.
All right, we always enjoy talking to you on the Jobs Day. U.S. Labor Secretary Marty Walsh, good to see you. Stay warm out there. We'll talk to you soon.
Thank you.
All right, it's been a good week for Spotify investors as shares close in on more than 20% gain following much better than expected earnings. Our chart of the day helps explain this gain. As you can see, Spotify's monthly active users grew 20% to 489 million last year. That marks an acceleration from the 18th growth rate seen in 2021. We'll be right back with another look into today's jobs report. That's next.
We got not just the jobs report today, we also got other economic data in the past few moments. The services industries are still growing and growing in a pretty big way. In fact, we saw the Institute for Supply Management Services Index, its non-manufacturing index, up by the most since mid-2020. So it was up 6 points to 55.2. 50.5 is what economists had been estimating here. So we keep talking about it through the prism of the jobs report this morning. Services jobs versus manufacturing jobs, right? What's happening on these two sides of the economy? We knew manufacturing was slowing down. Services was holding up pretty well. We've also been talking about services inflation versus goods inflation. But like all of this, prices paid, the prices paid component of this slowed down a little bit from December to January, but not by much, to 67.8 from 68.1.
Look, another strongish data point here, and the market is off its lows. I love what Wei Li from BlackRock said. There is still this fear of missing out and missing out on this rally. So despite data that would suggest maybe that Fed pivot is later off in the year, you still see money coming to this market, or you just see investors holding their positions that they've bought up over the past few weeks. I did think it was a very good point by Whitley.
And to your point, Julie, Fed Chair Jay Powell had kind of been a precursor to some of that, or at least commented on what we knew to be very true because of the data that was already showing up, and saying that they expect inflation to continue moving up for a while, but then to come down, assuming that leases continue to be lower. He talked about supply chains being fixed, demand shifting back to services, shortages on the supply chain being abated as well. So all of that kind of coming back and in through this reading as well this morning.
Yeah, and I should mention we also got the S&P Global PMI, which is sort of a similar number, but it's still showing contraction. The composition of these two different measures is different, so that's part of the reason why you get that.
Anything else? Anything else?
Exactly. Any other economic
what
data?
a
Let me
24
see
hours
what
for
else
markets.
I
No
can
more,
find.
Julie. Please stop it,
No,
please.
I think that's it.
break.
Maybe anybody want to report earnings right now? Saz is ready for you. Coming up, the markets may be down today, but Carvana's still climbing higher. Ines Ferre is going to dive into that story. Up another 1% today.
Oh, really kick it into gear. Welcome back to Yahoo Finance, live on this jobs report of Friday. I'm Brian Saza here with Julie Hyman and Brad Smith. Markets slammed as investors digest turbocharged jobs numbers with a whopping 517,000 increase in jobs for January. Brad, let's get over to you right now. We're seeing stocks off the lows of the session, off this strong print, but still, stocks are still down.
Yeah, let me show you what a slammed market looks like here on the day. Dow Jones Industrial Average right now lower by about 0.4%. So just off of our session lows there, but still down on the day. The Nasdaq Composite, you're seeing that lower by about 1% here. S&P 500, that's lower by about 0.75% here. And so just to put this in context and the move that we've seen over the course of this week, still net higher there. I'll put this on a line chart for you for the folks that don't like candlesticks out there. But anyway, net higher over the past 4 days by about 3.3%. We'll see exactly where we end and perhaps can hold on to, I would hope at this level, can hold on to these gains for the week that we have seen. But also taking a look at some of the other major areas that investors might be keeping their eye on today. And I want to go on over to the Nasdaq Composite because that'll give us a look at some of those mega cap tech stocks that have reported over the course of this week, where you had Amazon and Apple as well as Alphabet or Google reporting last night. All of those companies in focus right now. Amazon and Google lower. Amazon, you've got deep red there, down by about 5.4%. Apple holding on to gains actually right now, which is an interesting move considering the move lower that we saw on the reaction to earnings yesterday evening. It had actually moved lower by about 5% at one point and then started to pare some of those losses after the leadership team started to speak about the international opportunities, namely India and some of the conversions that they've seen there in iPhone, as well as in China as well, and the opportunity there. So that's up right now by about 2.5%. And then just lastly here, Alphabet, you're seeing that lower by about 2.8%. Google, Alphabet, Alpha Google, whatever. Guys, Carvana, that's also in focus. Shares are in focus after an epic week amid a major short squeeze. Yahoo Finance's Inez Ferrer, yeah, you know it. She's on the case. She's been tracking this one. Shares right now are up by about 2.5%. Inez, help us break this one down.
Yeah, this has been a really interesting stock to watch over the last week. But first, let's back up for a second to talk about what short selling is and what a short squeeze is. So short selling is when investors for a fee will sell borrowed shares with the help of a broker, and they agree to replace those shares by a later date. That means that they're covering their positions. Now, short sellers are betting that those shares will go down in price, and that spread to the downside would be their profit. A short squeeze is when a stock rises and shorts cover their positions, buying back shares at those higher prices, literally getting squeezed out of their positions, and that's what creates that upward movement in the stock price. Now, we saw this happening with Carvana, where Carvana's price moves, and this is a quote from our friends at S3 Partners, Carvana's price move has made it one of the most squeezable stocks in the U.S., with a short interest of 67% of the float. The float is the number of shares that are available for trading, and short interest really gives you a sense of how investors feel about a stock, that they believe that the stock will go down in price. Now, Carvana's all-time high, remember, was at $370 back in August of 2021. Last year, the stock was down 98%. This year to date, the stock is up about 200% because you are watching short squeezes on that stock, and you see it on the screen right now. Other notable names that have also had short squeezes in the past, of course, AMC, GME, you know the drill there.
So what are the other squeezable stocks that maybe could be? I mean, Carvana, you know, is not alone. We have seen this happen with some other companies, some of them you just mentioned.
Right, exactly. And usually these are companies that are facing challenges, and so investors are betting that share prices will go down. Lucid is another one. Lucid's short interest is 25% of the float, and we saw that stock really squeeze last Friday on that headline that was a speculation of a buyout. So these headlines are the catalyst, and then they will create these massive short squeezes. And in fact, I had an analyst from CFRA Research saying this is why it's so dangerous right now to be in electric vehicle stocks, because they got decimated last year. Investors are betting that the share prices are going to go down, and this creates a short squeeze when you see a headline and the share prices go up. Peloton's another squeezable stock, Open Door, Coinbase, Wayfair. Some of these companies, watch out.
Squeezable stock. I like that one. That's right. Thanks so much. Appreciate it. All right, before we head to break, Goldman Sachs analyst Eric Sheridan staying bullish on Meta, even in the face of the stock's post-earnings surge on Thursday. Sheridan rates the stock a buy and sees 10% more upside, says the analyst. While debates will likely persist around product transitions and industry platform headwinds in the quarters and years ahead, we remain focused on Meta's large-scale audience across their family of apps, against which the company can continue to align evolving consumption habits within short-form video, messaging, commerce, augmented reality, and social connections. Lots to consider there. Buy rating by Sheridan. Coming up, Kohl's is announcing a leadership shakeup. Julie is back with that, plus a look at other top headlines next.
Here's a look at some of the other headlines that we are following right now. And we start with retail giant Kohl's announcing interim CEO Tom Kingsbury will remain as permanent leader of the struggling chain. Kingsbury took the top job in December after former CEO Michelle Gass left for Levi Strauss. Kingsbury was a nominee of activist hedge funds McKellum Advisors and Ancora Holdings, with whom the chain agreed to other terms as it tries to reverse the decline in retail sales as it comes under activist pressure. Turning now to 3M, the 8th largest shareholder in the group is calling for better performance or a better chief executive, this according to multiple reports. A German asset manager invested in the company, raising fears about the conglomerate's recent earnings, revenue expectations, and outlook, and accuses leadership of being overly optimistic in its assessments. 3M recently announced layoffs despite job losses, bankruptcy for some of its units, and other challenges. And Twitter is trying to woo back advertisers during one of the biggest sports events in the country. The microblogging site offering advertisers a 3-day ad package with up to $250,000 worth of free ad space. That's according to the Wall Street Journal. The offer is described as a fire sale. It will see ads run ahead of NFL highlight clips. Twitter's been trying to turn around an exodus of advertisers spooked over concerns about new owner Elon Musk's approach to moderation, among other things. The platform has traditionally generated significant revenue from the Super Bowl as advertisers hope to amplify their game day ad content. Coming up, Amazon's cloud sector took a hit in the fourth quarter, or it didn't really take a hit, it just wasn't as amazing as it has been as of late. We're going to discuss that with an analyst from Cowen next.
Shares of Amazon, AMZN, taking a hit after the e-commerce giant reported mixed quarterly results, but it's the company's cloud division getting some buzz as Amazon Web Services growth, it decelerated while also falling shy of analysts' expectations. To dig in this further, we have John Blackledge, who is the Cowen Managing Director and Senior Equity Research Analyst here. John, great to have you here with us on the day post-earnings for Amazon. Just want to get kind of a broad brush stroke of your take from Amazon.
Yeah, I mean, if we look at 4Q and 1Q guide, we'll maybe start there. So 4Q revenue and op income beat, led by accelerating third-party retail revenue growth, while AWS growth slightly missed. The 4Q op income of $5.4 billion ex one-time items was above the $0 to $4 billion guide range. Then for 1Q, so that was good. So for 1Q, revenue guide range bracketed consensus estimates despite the macro headwinds and further top-line decel at AWS. And then the op income guide of $0 to $4 billion also bracketed street estimates, led by efficiency gains at retail biz, offset by AWS softness. So we tweaked estimates. We took the price target up to 150 from 140, maintain outperform. Amazon shares were up 31% year to date going into last night. I think they're tracking down 5-6% right now. And I think, as you guys were mentioning before I got on, I think it was the slight AWS miss, and the guide was a little bit softer, and that offset actually better retail revenue and margins.
John, is Amazon's leadership position in cloud at risk at all?
I don't think so. They are number one on an incremental basis in terms of their incremental revenue. It's probably, I think this year we have incremental revenue of $9 or $10 billion, and that's probably as much or more than Azure and Google Cloud combined. I think what they said last night was like a lot of companies, like we're seeing on the advertising side too, is the macro is having an impact. Companies are trying to find savings wherever they can, and that includes kind of in public cloud. And I think we had Alphabet report also as well last night, and Google Cloud's growth was really strong, but it missed what we had. It was a deceleration. So I think everyone's feeling it. It's just like AWS is the biggest. They're working off the largest base, and they're not immune to kind of various macro headwinds.
John, are you disappointed that Amazon doesn't appear to be moving quick enough with cutting expenses? Sure, they just had the recent RIF or laying people off, but they don't seem to be in the high gear of trying to get their margins up.
Yeah, I think it's a great question, and I think everyone was looking for the margin last year, and we didn't get it. And we didn't get it for a lot of reasons. You had a higher labor cost with the headcount adds last year. And I'll get to the cuts for this year. Energy inflation, supply chain inflation, doubling the fulfillment network the last 2 years. All these various investments. As we get into this year, some of those headwinds are going to be tailwinds. We obviously had the headcount cut, 18,000 heads cut. So I think we'll start to see that as we go through the year. And then the energy and supply chain inflation, that's going to be at their back. And I actually think you saw that kind of show up a little bit in the fourth quarter. Their shipping costs were up about 4%. So that was a pretty big decel. And obviously, we'll see what they do on the capital investment side. We think it's going to be down this year. We have CapEx down mid-teens. So, but I understand the question because I think Meta came out and they said, hey, our OpEx and our CapEx are going to here and here, and it was lower than their prior guide. Whereas Amazon and actually Alphabet didn't give that, quantify, kind of the cost savings. But when I talked to them after the call last night, they're like, hey, we're making surgical cuts here. We're doing headcount cuts. We're streamlining as much as we can. And I think it'll show up as we get through the year. But as we, kind of said, like that 1Q guide was, the op income guide was solid. But after the fourth quarter op income number, I think investors were also a little bit disappointed.
John, just to go back to cloud for one second, not just at Amazon, but overall, when do you think the cloud, how long do you think this sort of dip in spending on the part of clients is going to last?
Yeah, it's a great question. We struggled a little bit modeling it out last night for both Amazon and Alphabet, but we basically think it's going to, we have the decel in 1Q. I'll just take AWS, for example, a further decel in 2Q, which I kind of feel like they didn't say that because they don't really guide Amazon, but that's what I thought the messaging was, and then kind of stabilizing and then maybe tick up maybe towards the end of the year. But it will obviously be dependent on the macro. If the macro gets worse, then it'll probably be lower. But I would say, and we didn't get this number last night, but they do put it in their filings. They said the backlog at AWS is strong, and so we'll wait to see that number. But yeah, it's a little bit TBD, to be honest with you.
Hey, John, just quickly, is there anything that could trigger a super cycle type of upgrade for that cloud services division? And I use that super cycle kind of analogy just to kind of pair back to what we may be used to even with an Apple on the product side.
They're always introducing new products and services, and I think governing the growth trajectory this year is the macro. And not to get away from your question, but the AWS, for example, they basically, their product cycle it's kind of like a virtuous cycle. They lead with their infrastructure services, and then customers tend to need things, and then that helps them with product ideas and leads to this virtuous cycle. And so they're always innovating, as is GCP at Alphabet and Azure. But more so, I think it's more, at least for this year, probably more macro oriented as it relates to going back to the numbers and trajectory for the businesses.
John Blackledge, Cowen Managing Director and Senior Equity Research Analyst. Good to see you. Have a good weekend.
Thank you. You too.
Coming up, we'll get more reaction on those January jobs numbers on the other side of the break. Let's look between the lines of today's shockingly strong jobs report. A whopping 517,000 rise in jobs for January doesn't necessarily mean strong gains across every single group. Some vulnerable workers finding the recovery uneven. Here with more, Bill Rogers, director of the Institute for Economic Equity at the St. Louis Fed. Bill, always nice to get some time with you here. Where are you seeing the most unevenness? Because today, at least from the vantage point of investors in the markets, this was a good jobs report, but your research may suggest maybe that's not the case.
Yes, good morning, and thanks for having me. And I think it's still okay to say Happy New Year. Haven't seen you since, since last year. It's what we're seeing in the data is number one, as you said, and I'm very happy that we're continuing to see robust job creation, because there is a long-standing relationship that as the economy improves, you end up seeing improved opportunity for Black individuals, for people with a disability, for young people, particularly those who are out of school and they don't have a college degree. And in our research at the Institute, it's shown early into the summer, into the fall, that many of these groups, their employment population ratios, that is the share of their populations that had a job, had begun to fall. We've extended that work and have found that into November and December, and probably this month when we get the new data at the individual level, we'll end up seeing that there hasn't been a vast improvement, but the slowdown has thus far been averted. So the bottom line here is that for those vulnerable groups who typically have lower participation rates, people with disability, young minorities who are out of school, Latinos, young Latinos. That there was an erosion into the third quarter or into the fourth quarter, but that seems to have been abated. And today's numbers will help to continue averting a slowdown amongst these more vulnerable groups.
Over the past 2 years, we've seen a wave of pledges by every kind of corporation and across sectors, whether that be in the banking sector or whether that be in the athleisure and apparel sector, about how we can start to narrow this gap in terms of the equity and really kind of make sure that there are people who are not left behind, given the fact that there had been so much disparity between and within the racial wealth gap, there had been so much disparity for years and also almost baked in. So with that, have you seen anything that's been successful within that regard thus far and those pledges and commitments?
Well, that's a great question. And one of the things that we're actively trying to think about in terms of where do you start the counter of looking and trying to see if we're getting improvements. And so, so what we're doing before we're really diving into that area, what I've been doing and my staff have been doing is really developing what we're calling cases for equity, just to help people understand, such, for example, from a business case that we have estimated for St. Louis, our St. Louis economy, that would be an additional $6 billion in disposable income to the community if we were to pursue equity, economic equity, in terms of, in this case, moving Black incomes more towards those of white incomes. We've also seen, like in Memphis, that would be again several $1 billion of additional disposable income that would come into the economy. And the punchline here, or the point here, is that as you saw, you talking about these various businesses, we're helping to provide a rationale, or offering a rationale that, hey, if you help to act affirmatively, and that could be your own employment, hiring, and promotion approaches, but it also could be being that good corporate partner in the community that there's a win-win here that will improve equity, but also prosperity will be broadly spread and experienced.
Hey, Bill, it's Julie here. This seems like a compelling argument. It's not an entirely new argument, even if we have some new numbers around it, right? So right. What's the holdup? Is it just that we still have institutionalized racism that is that entrenched, that is holding back? Are there more sort of specific things that you can pinpoint? What is not working in this direction?
Yeah, that's a great question, and great to see you. And One of the challenges is that, as you said, you have these institutional structures that have existed for generations, and it's very, very hard to unwind them. And so that's why I'm spending a lot of time traveling my 8th district. I'll be in the Delta, Mississippi Delta, next week, talking to leaders there in sharing these cases for equity. Another case that I've developed is borrowing some of building on that work that Dr. King did. I was reading one of his recent speeches or his interviews where he was at the Southern Seminary and talking with students there, and he actually said, like you said, he was building that economic case, and he was perplexed at that time. It was like, why is it that that certain businesses really don't want to pursue equity, even though it would help to improve their bottom line? And so, my role that I focus on is just really providing education, providing those narratives to people in their various communities, to that they can then use them at a cocktail party. They could then use them in their workplace to help themselves create change.
So, Bill, bringing this conversation full circle back to the news of the day as well, within the employment data that we've been continuing to track, of course, there is the elevated unemployment rate for Black Americans, and that in comparison to the broader kind of average among the labor force participants. But then you also think about the wave of layoffs that have also taken place and how that has disproportionately impacted some of the more kind of the more marginalized groups within the workforce as well. How can we ensure that there isn't a larger ranging implication or impact to ethnic groups that are underrepresented or had been underrepresented coming into this hiring wave that had taken place, especially across some of the tech companies that said that they overhired?
Yeah, I mean, that's a great question. And I think some of the evidence that's been compiled is that the one importance is transparency. Right, is that people have a clear understanding of what the rules of the game are, and I think also we've seen the important role of institutions, and I think in this report, particularly, there's another example of how institutions matter. That we saw that, right, leisure and hospitality, that was one of the leading industries or sectors that had this job creation. Well, at the beginning of January, over 20 states were required to have required that their minimum wages be raised. So what you may have gotten going on here is people were being attracted to pulled into leisure hospitality, particularly because wages, and again because of the institutional framework of the government of the minimum wage, that those legislative pieces led to higher wages, and then that went above what is called people's reservation wages, that indifference between working and not working, and they were drawn in. Now, I have to caution that this is one data point, doesn't make a trend, so we'll be following this over the next few months.
And we'll check in with you as you do that. Bill, it's always good to catch up with you. Bill Rogers, Director of the Institute for Economic Equity at the Federal Reserve Bank of St. Louis. Thank you, and have a great weekend.
You too. Thanks.
Thanks. Coming up, we'll do a deep dive into the state of hospitality with the CEO of Lightspeed. That's next. Let's get back to the jobs report now. And in particular, one of the areas where we saw pretty big growth that we've seen consistently in the jobs report, that is in hospitality, restaurants as well. Let's talk more about some of the challenges within that industry as they hire a lot of people, but they probably like to hire more. JP Chauvet is joining us now, Lightspeed CEO. Lightspeed, a vendor for many of those restaurants. And you guys just came out with your State of Hospitality report. In it, you said after inflation, the largest issues are hiring new staff and staff retention. So it being Jobs Day, JP, I want to start you there. Talk me through what restaurants are currently seeing on that front and whether anything is changing.
Yes, good morning, Julie. Thanks for having me. Nothing has changed from the last time we spoke. In this industry, what you see is that restaurateurs and retailers also are having a really hard time hiring people. And here you're faced with the reality of the return from COVID, where the businesses are more complex than they've been. They need to serve online and serve now, of course, everybody back in the restaurant. And so that means a lot of needs for more people, which they're having a hard time finding. And so that's why companies like Lightspeed, what we do is we help them implement technology to do more with less.
And so what we did see within this data from the employment situation was food services, drinking places, they added 99,000 jobs. That really made up the brunt of that leisure and hospitality uptick there. And of course, this has been the recovery story that's needed to happen. Is it happening quickly enough from your perspective? And what further kind of incentives perhaps need to be put out there for employees to start making their way back into this sector, particularly, JP?
Yeah, I think really what happened is during COVID, everybody realized that there's a life outside of hospitality, and they were let go, and now they're really having a hard time bringing people back. I know that it looks good. I mean, we've hired quite a few, but there's still a long way to go. And really the majority of our customers, we have about 167,000 customers. The majority of our customers around the world are still lacking staff everywhere, in the kitchen, in front of house. And so it's really been very difficult for them. And so here what we're seeing is they know that they need to automate mundane tasks. They need to have fewer servers or fewer waiters, do more and serve more tables. And so they're turning towards technology right now to try and kind of compensate for this lack of people. But there's still a long way to go.
Of course, that's where your sales pitch comes in, right? That you guys sell some of that technology. For your clients, is part of the argument that they won't need to hire as many people if indeed they're using your technology. I mean, this is sort of part of what is a big debate right now, whether we're talking about the kind of technology you sell, whether we're talking about AI, which is a hot topic right now. There's this debate over whether it's replacement or augmentation. How do you talk to your clients about that?
I think it's really doing more with less. And I think so. I'll give you an example. A large customer of ours in Europe, they went with new technology for tableside. So with people with iPads serving at the table. And they told us that they increased productivity per waiter by 30% just by implementing a tableside POS. So I think there's a real runway here, and there's an opportunity for the industry to really reinvent itself and to use technology to just provide, I think, two things: a better experience for your customers, and also at the same time just augment productivity. And so 30% just by implementing, a table device platform instead of having your old, point of sale on the counter. So I think there's a lot of room. We're hearing also that, all of the new payments technologies, with QR codes and tap a table, and all of these are also just there to augment productivity. So I think the big thing we're hearing from all of our customers is we need technology to do more because we can't hire, and the cost of labor is actually going through the roof. So the only way they can bridge the gap to profitability is by adopting technology.
Let me just pick up on the last thing you said. The cost of labor is going through the roof. We've had so much debate today over, and we've been listening to company conference calls about whether wages or costs of any kind are going up at the same rate. Within hospitality, are wages going up? Is the increase in wages slowing down?
Well, for sure, the wages are not going up at the same rate as the cost of the goods. So I think, and I think, Julie, when we were together in New York, we had a restaurateur say, do I need to put a burger at $30 to be able to strike a profit? So I think really what you're seeing is the cost of goods has gone up quite drastically. The cost to serve has gone up, but this doesn't translate in the consumer accepting, the increase in the good or in the sell price of the good. So I think there's a real challenge there. And I think the only way out is to really have fewer employees or fewer waiters or fewer staff that can automate as much as possible. And I think here, when you look at what happened with COVID, you really have what we call omni-channel or multi-channel. You have all these delivery networks that you have to manage. And so there's a lot of silos. There's a lot of room to just do more in terms of how do I adopt technology? How do I, synchronize all these channels and drive a simpler business? And I don't think the wages going up, or I don't think they'll be able to cover for all of that if they don't adopt technology. And technology hasn't evolved for, arguably 100 years inside of restaurants.
Sure. And for a technology prioritized business like your own that I imagine has some very favorable margins that come along with that, have you had to reevaluate your own cost structure right now?
Well, we are like everybody else in this industry. Our cost to serve has gone up because, we have a very large staff of support people, even cost of infrastructure or Amazon. So we are facing exactly the same challenges as everybody on the planet, which is our cost to serve has gone up. And how do we continue to serve customers in a profitable way? And so I think for us, we're looking at different ways to try and adapt to that world. And one of them, of course, is scale. And so we're trying to scale as quickly as possible so that we can lower the cost to serve.
JP Chauvet, who is the Lightspeed CEO, joining us here today. JP, that's all we have time for here today. We'd love to check back in the future. Appreciate the conversation.
Thank you very much. Thanks for having me.
Coming up, everyone, we'll do a quick recap of the January jobs numbers, and we'll take a quick look at Apple before we depart you for the 11 a.m. hour.
We started the 9 a.m. hour, three things. We're going to end the show with three things as well. First up, we recap the January jobs report. And as we know, big number here, 517,000 jobs added to the U.S. economy in January. Unemployment falling to 3.4%. Stocks are not doing what they were doing earlier. Out of the gate, we had a big decline. And now we're mixed. Things aren't that bad after all. Everything's okay, you guys.
Well, it looks like it's okay with Apple. I think Apple, this reversal we're seeing here, Brad, maybe they're going back to what we caught on the after the call last night, after that earnings call, where Tim Cook mentioned a little bit of a budding turnaround in China. Maybe people are reviewing this conference call performance by Tim Cook and saying, you know what, we like what he said on China. We're going to get in here and buy that stock.
Yeah, we caught this earlier on in the hour here, and continuing to look like that move is actually heading on to some of the gains that we'd seen earlier. It was up by about 2% earlier, now up by nearly 3.5%. So for Apple, services and Greater China was really two of the bright spots in the earnings report. Perhaps, as you mentioned a moment ago, investors giving a little bit more outsized weight to that.
Yeah, and also Jim Suva from Citi telling us that FX, the currency effects, were a big problem for Apple. So that doesn't really imply that there's a fundamental issue with demand necessarily at Apple if it's sort of currency conversion. Maybe. That at least was Suva's view. And finally, thing number three, at least on my radar, remember we've been talking about this AI phase right now harkens back to the slap a blockchain on the name of something and it goes to the moon.
Yeah.
There's a company called Nerdy that I'd never heard of before. Nerdy apparently said it would debut two new AI-powered products and integrate ChatGPT into its existing product suite. And look what happened to the stock. It's up by 14%.
Sounds promising.
Right now. It's about a $300 million company. So it's a little company.
Go get 'em, guys.
Said something about AI.
BuzzFeed, similar. We saw that move. The AI slap on.
Everybody wants that AI magic right now. All right, coming up in the next hour, Secretary Blinken's trip to Beijing is canceled or at least postponed after the detection of what has been called a Chinese surveillance balloon over the United States. Rochelle Akufo is going to discuss with an analyst a very fascinating story. That does it for us. Have a great weekend, everybody.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo, and here's a look at what I'm watching this morning. The January jobs report blows past expectations with 517,000 workers added and hugely complicating the picture for the Federal Reserve. Now, is this a big shock or just a noisy number? We'll discuss. And tensions between the U.S. and China ramp up, and it's official. Secretary of State Antony Blinken will not be going to Beijing for now. We'll tell you why and look at the ties between the world's two biggest economies. And Tesla defies January's various headwinds to report strong sales in China. Is this all down to those price cuts, though? We look at how Elon Musk's industry leader is managing to buck the trend. But first, let's take a look at the major indices. As we see now a mixed picture, despite all three starting in negative territory, buoyed a little bit as they start to digest some of those job numbers, trying to sort out some of the noise and some of the seasonality and some of the changes that the BLS made. But still, we see the Dow, they're the only one in the green, they're up about 40 points. The S&P down about 0.2%, and the Nasdaq, they're down 27 points as well. Now, of course, let's take a look at the Treasury market, because any indication that the Fed might have to do a bit more work with that strong jobs number meant we did see more going into yields today. You see the 5-year there up almost 5% on the day, the 10-year up 4%, and the 30-year up 2.5% on the day. Well, the U.S. economy added 517,000 jobs in January, blowing past estimates of 188,000. But not all may be what it appears, as mentioned by RSM chief economist Joe Bruselas on Yahoo Finance earlier this morning. Take a listen.
Let's all take a step back and breathe. January has lots of seasonal noise attached to it. This report, however strong, exaggerates the true underlying pace of hiring in the economy.
So taking it with a grain of salt there. So here to dissect this further is Yahoo Finance's own Ines Ferre. Hey, Ines.
Hey, Rochelle. Yeah, and there are a couple of factors to take a look at when it comes to this January report. One of them is population adjustment when it comes to the household survey. This is one of two surveys that is considered in the jobs report. And the household survey data for January 2023 reflects updated population estimates. So there's that. There's also the issue of seasonal hiring, and this is a quirk in the labor employment survey. Now, retailers tend to hire seasonal workers in the fall than they let them go in January. But last season, there were less seasonal hires. So perhaps fewer workers laid off. So that would boost those January numbers as well. And then you have to take into consideration a seasonal adjustment. So 1 year ago, you had COVID's Omicron variant that reduced payrolls, but it wasn't an issue this past January. So that helped January's employment total after seasonal adjustments. Also want to point out the University of California workers that went on strike. You had last year, and that lowered employment in December. That's been resolved. So that would increase in the, employment in the public sector by about 36,000 jobs, according to economists.
And certainly an eye-popping number there, but good to have that context there that makes January's numbers a little bit skewed here. But a big thank you there to our very own Ines Ferre. Well, as January adds an eye-popping number of jobs to the U.S. economy, the rate of employment came in below expectations as average hourly wages cooled down to 4.4% in January. So what does this mean for markets as investors navigate the slew of economic data and earnings? We're here to discuss is Jeff Klingelhofer, Thornburg Investment Management co-head of investments. Good to see you, Jeff. So as we break some of this down, obviously you have this bumper number, some nuances in there as well. What are investors making of this picture as we saw the markets tank initially, but at least starting to come back a little now?
Yeah, look, I think this is a monster of a jobs report. And really, I think this is the Goldilocks scenario for both equity and fixed income, right? Coming into the year, we've seen fixed income yields decline. We've seen equities move notably higher. And all of this is on the strength of the consumer. And I think what we saw from this morning's jobs number is just confirmation. The consumer continues to be strong. And ultimately, where we're heading is a period of sustained higher inflation coming from a very strong labor market and sustained higher wages. This is great for markets.
So then what about for Powell? Because we know he tried to give it ended up being a more dovish tone, at least from the market's perspective. Does this jobs report at least take some of the pressure off him, saying, look, clearly there's still some work to be done?
I don't think it takes the pressure off of him. But look, in my perspective, Chair Powell has been incredibly transparent with markets. They're going to continue to hike. They're going to find a terminal Fed funds rate of slightly above 5%, and then they're going to pause for a prolonged period. The market's been discounting this for the entirety of the year thus far, and really through much of the last year. The market's expecting that they get to terminal Fed's fund and are forced to cut very quickly thereafter. And I think, again, what this jobs number this morning points to is confirmation that ultimately the economy is, at least as of now, on a very, very strong track. Again, pointing to sustained higher inflation, pointing to sustained higher rates, and really, to me, an opportunity within fixed income markets.
So let's talk about some of these opportunities. What are some of the best ways investors can put their money to work right now?
Yeah, look, I think as I've been listening to the show this morning, we hear looking forward, there remains a significant amount of uncertainty. But that's really where fixed income shines. Yields are notably higher today. The consumer, at least as of now, remains on strong footing. For us, it's focusing on both yield generation, primarily within the securitized market, focusing on the higher quality portion of the consumer side, and balance that out with longer duration treasuries, right? The ability to reinsert ballast within a portfolio.
And you highlight in your notes the income component of fixed income. What are you honing in on there?
Sure. For us, today's marketplace is the old world of fixed income is back. The ability to have not only some capital appreciation, which we've seen year to date, but really it's the ability to generate a very interesting level of yield. Today, to find 6% in a broad fixed income portfolio is relatively easy. And 6% offsets a lot of the inflationary pressures for your average investor. But importantly, for managers that focus on the defensive component of fixed income, like we do here at Thornburg, right, you have a rates backdrop where if we do head into a much deeper recession, ultimately the Fed will be forced to cut rates and you can reinsert ballast into the portfolio. So the ability to generate an interesting income and offset with really the preservation of capital side of fixed income today is tremendously, tremendously interesting.
And one of the ways you're looking at keeping your asset allocation a bit more balanced is also keeping an eye on what's been happening with gold. Under some pressure today, but still positive for the year so far. How do you see that progressing?
Sure. I mean, as I look at really coming out of the press conference this week, I was perplexed at the market reaction, right? The only way that I can square a move higher in equities and a move lower in yields is the Goldilocks scenario that, at least as of this morning, it seems like we're getting, where labor remains very strong, yet potentially inflation comes down. Now, it's not my base case, but into that, the potential the Fed cuts. But the reason why I like gold here is looking forward, the Fed would be cutting in that scenario, looking back with very high inflation, right? Stimulating the economy at perhaps the exact wrong time. So to us and within our asset allocation portfolios, gold can serve as a pretty interesting place as a hedge on future inflation if monetary accommodation does continue.
And Jeff, depending on your time horizon, say if you in the 1 year, perhaps 1 year mark versus some of these longer time horizons, really planning for what happens on the other side when the Fed does eventually pivot or perhaps decrease interest rates, what's the play there?
Sure. For us, it goes back to again, yield generation, but also a focus on defense. While across the cycle, the world of high yield looks pretty interesting, we worry about the potential future volatility, right? Last year was entirely explained by the movement in risk-free rates, but ultimately spreads were relatively contained, and that continues into this year. And so we're at this point a little hesitant to move into the world of high yield, very selectively, more defensively oriented companies like healthcare that continue to have pricing power, insurance, et cetera. But really what we want to focus in on is not just our base case, one of at least a slowdown in growth or perhaps even a mild recession. But importantly, as fixed income investors, we also need to focus on the left tail, a much deeper recession. So within the world of high yield and income generation, always keeping an eye towards defense and building robust portfolios to perform throughout the cycle.
And certainly a lot of unexpected moves could be ahead, but we'll be keeping an eye on what happens with the economy and, of course, how investors react. Jeff Klinkelhofer there, Thornburg Investment Management, co-head of investments. Thank you so much for joining me. All right, well, shares of Ford driven downward following its latest financial results as fourth quarter and full year 22 operating results came in below expectations. You see the stock there off about 5.5%. Now, Ford citing its lackluster performance in part to execution issues in an environment with supply chain and production instability, resulting in higher costs and lower than planned volume. Now, the automaker also suffered a full-year net loss of $2 billion, as CEO Jim Farley says the company is going to correct this with, quote, improved execution and performance. Now, Ford is expanding its cost-cutting efforts, now looking to eliminate considerably more than the $3 billion in annualized expenses previously targeted by mid-decade. All right, coming up, the Biden administration is reportedly postponing Secretary of State Antony Blinken's trip to Beijing. But why? Well, the reason might be out of this world. Stay tuned. Is it a bird? Is it a plane? Or is it a Chinese surveillance balloon? Well, according to the North American Aerospace Defense Command, the United States government has detected and tracking a high-altitude surveillance balloon that was seen flying over Billings, Montana on Thursday. Now, a spokesperson for the Pentagon says they have been keeping an eye on the balloon for several days and say that it's traveling at an altitude well above commercial air traffic and does not present a military or physical threat to people on the ground. Now, President Joe Biden was briefed on the balloon and took military advice to not take it down due to the risk to the safety and security of people on the ground from possible debris. Now, Chinese authorities have confirmed it was a civilian airship intended for scientific research. Well, this comes, of course, as Secretary of State Antony Blinken was set to meet President Xi Jinping in Beijing in the coming days. But now the Biden administration has decided to postpone Blinken's upcoming trip to Beijing following the news of that balloon. Now, any future conversation between the two would make Blinken the first U.S. secretary to sit down with the Chinese leader in nearly 6 years, and the first of President Joe Biden's cabinet secretaries to visit China. Well, for more on this, we welcome in Zongyuan Zoe Liu, Counsel on Foreign Relations, Fellow for International Political Economy, as well as the author of Sovereign Funds, How the Communist Party of China's Finances Its Global Ambitions. Good to have you on, Zoe. So obviously, you have this complication here with this trip being postponed. What should we read into this? Will you try and sort of characterize it as to really this sort of disjointed relationship that the Biden administration has had with Beijing?
Yeah, thank you very much, Rochelle, for having me. The postponed trip, to be honest, I'm not necessarily surprised, to be honest. part of this is because on the one hand, neither China nor the United States have officially confirmed that Secretary Blinken is going to go to China, even his trip is supposedly to start tomorrow, right? Then on the other hand, obviously the complication of the balloon situation did not help at all. But on top of this, remember what has been happening in the background. There are a couple of things that I'd like to highlight. On one hand, there is the scheduled House Speaker visit to Taiwan, and there is also a series of U.S. export controls against Chinese entities, and in particular highlighted Huawei. And then finally, as of yesterday, the United States announced that we gained four additional base access in the Philippines. So a lot of this really did not surprise me. And this goes back to your point. This adds a lot of strain to the bilateral relationship.
So, I mean, when you have a backdrop like that and you have this visit that was supposed to take place, what really is at stake here? And what does this visit actually mean for the U.S. China relationship? Is it a resetting, or are the expectations too high for that?
Oh, that's a great question, Rochelle. And I think reset is actually the word that many foreign policy communities, both here in America and in China, would be really looking forward to. And if anything, you remember when President Biden came into office back in 2021, the Chinese officials were really looking forward to a reset in the bilateral relations. But unfortunately, so far, we haven't seen this. And even before Secretary Blinken postponed his trip, a lot of the public opinions and the commentators or state-run media commenting on the prospective of his visit the expectations was very, very, very low because of all these things happening in the background.
And so we're likely not going to see some of the more complex issues with this first visit when it does take place. But what is supposed to be on the agenda for this visit?
So supposedly, I would say the bottom line is both sides have very different expectations. In other words, the expectation gap is relatively wide. So on the one hand, the United States would expect that they would on the one hand meet high level new generation of Chinese leaders, and they would also want to reaffirm the agreement during the Biden-Xi meeting alongside the G20 summit last year. And they probably also would want to touch upon the issue of Russia's war against Ukraine, how to end the war, the role of China. And then probably they would also want to ask China to end the series of sanction measures imposed on U.S. entities and U.S. individuals after House Speaker Nancy Pelosi's visit to Taiwan last year. And in other words, a lot of these are meant to put a bottom line to prevent a crisis between U.S.-China in the relationship between United States and China. However, what the Chinese government and Chinese officials are really looking forward to is to, on the one hand, making sure that, crisis management, putting a bottom line is not enough. They are really looking forward to have exactly as what you are saying, reset in the relationship. And more specifically, they want probably the United States to acknowledge or respect what China considers as its core interest, especially with regard to Taiwan and other sensitive issues such as Xinjiang.
And when you speak of core issues, and you mentioned Taiwan, obviously the biggest semiconductor chip producer in the world, but then you have, the Biden administration tightening its rules of certain U.S. technologies to China, starting to have talk of some limited investments in China as well. And then, so what does that mean then? I mean, I'm assuming we're not going to have that conversation at this sort of meeting if we want to see any sort of progress. But how does that dynamic, do you think, play out?
So that's a very interesting question you asked, Rochelle. And you are absolutely right. Semiconductor is really right to the core of the conversation right now here. However, I would say for us, the United States interest in Taiwan is not necessarily to protect Taiwan on its own. I've been arguing this for a long time that our interest in Taiwan is not Taiwan per se or Taiwan sovereignty or whatever. Our interest in Taiwan is really from our own interest, supply chain and American business interests, and to what extent the semiconductor supply chain actually it fit into United States national security interest. And from that perspective, actually China sees it very similar as well. But on top of that, in addition to semiconductor, or let me step back, regardless whether Taiwan has or has not a semiconductor, China's perception or China's interest in Taiwan has always been, or how the Chinese Communist Party, Chinese policymakers consider Taiwan as part of China. And that is something that Chinese leaders would not negotiate.
And as you mentioned, they're coming from two very sort of interests there when it comes to Taiwan. But as we mentioned, things like geopolitical tensions, one of the reasons that we're starting to see some of these companies, some US companies, diversifying their supply chains away from China. But there are obviously other factors at play as well. Break some of those down for us.
So, that's a great question, Rochelle, again. So in terms of, I would say, the core of your question really is about, factors at play that might have accelerated decoupling, right? So on the one hand, in addition to all these geopolitics and all that, I would also say that actually from business interest perspective, pure market dynamic perspective, decoupling or for that matter, supply chain relocation already happened before U.S. China trade war. And the pure reason for that from market perspective is really because labor costs in China has increased, land costs. In other words, what made China attractive as a global manufacturing center is no longer there. And then on top of that, there has also been a lot of major policy swings from President Xi Jinping's discussion of a common prosperity, the crackdown on the tech sector. A lot of these uncertainties made it seems that China is no longer welcoming international business, despite that the Chinese government and the NDRC, the NDRC State Council consistently say, actually, we are still interested in international investment. So policy major swings adds to business uncertainty, and business don't like that. And then finally, COVID really seals the deal in terms of major supply chain disruptions.
So a lot at play here, a complex relationship. We'll have to see what happens if Secretary Blinken does eventually make it to Beijing. A big thank you there for your insights. Zhongyuan Zoe Liu there, Council on Foreign Relations Fellow for International Political Economy. Thank you so much. All right, coming up, Tesla defies January's various headwinds to report strong sales in China. Is this all down to those price cuts, though? We'll discuss next. Now let's take a closer look at Tesla. And it seems price cuts in China are paying off. Preliminary data from the China Passenger Car Association reveal the company's China-made vehicle sales surged in January, up 18% from December, meaning that Tesla sold 66,051 China-made electric vehicles last month. Now, this, of course, comes amid a troubling backdrop in the world's second biggest economy. Tesla's Shanghai plant cut output by a third in November in a bid to cope with rising inventory. Now, Reuters report this week suggested the EV leader is now planning to step up output at that facility over the next 2 months. And to put that in perspective, Tesla was the second biggest selling car maker in the nation last month after BYD. It shipped over 150,000 cars during that period. Now, of course, competition in the space has been accelerating quickly, and China continues to be viewed as a key battleground. Sales of new energy vehicles, which include battery-powered cars and hybrids, are expected to grow in the nation in the months to come. And to keep up with demand, the company is reportedly considering building an electric vehicle plant in Mexico City. According to comments from a presidential spokesperson, the facility would serve as an export hub for the group. The factory is expected to cost anywhere between $800 million and $1 billion. Tesla shares on the rise today, as you can see, they're up almost 5%. Well, a shareholder class action trial against Elon Musk and certain Tesla board members enters its final stage today. Tesla shareholders are suing over Musk's 2018 tweet saying he secured funding to take Tesla private. Yahoo Finance's Alexis Keenan is following the story and joins us now for more on this. Obviously, a lot of people wondering what was going to happen with this, what seemed like an off-the-cuff tweet, but so much went into it.
So much and potentially so many consequences for this tweet and the one that followed. So the 9-member jury that's hearing this case in California, it's a federal shareholder class action against Musk as well as Tesla, as well as certain members, current and former members of Tesla's board. They could get the case as soon as today to start deliberating because in just minutes from now, closing arguments are slated to begin. Now, these shareholders, they say that they lost billions of dollars in trades because they relied on that tweet from Musk in 2018 in August that said he had funding secured to take Tesla private at $420 per share, and that they relied on a second tweet that later that same day affirming that investor support was confirmed. Now, over this 3-week trial, the jury has heard evidence from the shareholders, from Musk himself, from Tesla's board members, also economic experts, as well as Tesla's former CFO. For Musk's part, he testified that his tweets were, quote, truthful. He said they came after talks with Saudi Arabia's public investment fund that gave a verbal commitment through its representatives. And Musk said that that commitment to fund this take private deal was, quote, unequivocal. He also said that even without Saudi funding, that he could have sold his shares in SpaceX to fund this kind of a deal. And so he said he didn't necessarily need it. Also, the jury here, they're tasked specifically with deciding if Musk believed that that funding secured tweet and the subsequent one, if he believed that to be true at the time of the tweet. That's what they're going to have to decide. They're also going to have to figure out if that information was material, and that's the type of information that a reasonable shareholder would rely on in making decisions to buy or sell the stock. Also going to have to decide if the market volatility that followed those tweets, if that is actually if it was caused by Musk's tweets there. So a lot for this jury to take to deliberate. They will likely get the case today after closing arguments. And so I suppose we could get a decision even as soon as today. Rochelle?
I mean, this will be a fascinating one to watch. I mean, but how much money, though, do these Tesla shareholders claim that they lost based on Musk's tweets?
So in this complaint, the shareholders do not allege a specific dollar amount. However, they're talking about money losses during a 10-day period that was from the day of the tweet on August 7th, 2018, up until the 17th. Now, the market cap swing for Tesla during that time frame was approximately $12.6 billion. But then you had shareholder experts, economic experts, testify, one in particular who was willing to put a dollar figure range for the regular shareholders who bought and sold. And this is completely excluding all types of options contracts that existed during that time. That expert testified that those losses were between $4 billion and $11 billion, coming to $22 about and $66 per share. Rochelle?
I mean, this is a tough one, trying to figure out that intention and then looking at that timeline of what happened with the stock price afterwards. Great stuff. Alexis Keenan there. Thank you so much. All All right, coming up, Meta's year of efficiency plan caught the attention of investors yesterday. So is the idea simply doing more with less? And is it achievable? We'll discuss next. Meta might be grappling with some overhead cost. The tech giant out with some interesting stats about just how much it takes to run one of the world's largest social networks, especially during earnings. Now, Yahoo Finance's Ali Garfinkel with more on how it's set to affect their bottom line. The year of efficiency, Zuckerberg said.
Yeah, and Meta told the most convincing cost-cutting story this week, Rochelle. Among all the big tech tickers, they actually did the best in a lot of ways. And though a closer look at some of these cost-cutting strategies I think is worth doing, because it becomes clear that they're trying to eke out profits just about wherever they can. One of those areas is data centers. Now, if you have to explain to your parents what a data center is, imagine a building with lots of internet infrastructure servers, that kind of thing. So, that sort of thing is essential for tech giants, but they also can get expensive, right? Real estate, servers. And in Meta's case, what they're saying is that they're set to save at least $3 billion on these data centers in some cases. It could be as much as $4 billion. In the call, they said, and I quote, "We expect capital expenditures to be in the range of $30 billion to $33 billion, lowered from our prior estimate of $34 billion to $37 billion. The reduced outlook updates our reflected plans for lower data center construction spend in 2023 as we shift to a new data center architecture that is more cost efficient and can support both AI and non-AI workloads." So they're thinking about AI at a moment that's really clear. However, it's important to say that this plan, while it seems like it makes sense, is a little vague. A lot of analysts I talked to said as much. What they've understood is this. Meta's plan is to build out spaces over time instead of buying buildings all at once. Now, that seems like it makes sense. However, over time, it might end up costing more money. It's a borrowing from Peter to pay Paul situation.
So then what does that efficiency mean for a company like Meta?
I think it's complicated, Rochelle, because they also are losing a lot of money on Reality Labs. Let's remember, despite the numbers that everybody's really excited about, they still are losing billions, and they are projecting to continue losing those billions. Now, the Reality Labs payoff, the metaverse payoff, Mark Zuckerberg is saying, is in 2023. So it's going to be an interesting task to try to sell efficiency while also being convincing people that these losses are worth it and worth it over time.
All right, thank you so much. A lot of stuff to unpack there, but we're seeing at least the stock price enjoying some rewards today. Ali Garfinkel, thank you so much. All right, well, turning now to jobs, we're seeing a whopping 517,000 rise in January, which of course draws a sharp contrast to the recent headlines of major tech layoffs. Now, outplacement specialist Challenger Gray and Christmas seeing cuts also in retail and real estate. Now, here with more is Andrew Challenger, Senior Vice President and Head of Sales and Media at Challenger Gray and Christmas. Good to see you here. So a lot of us are trying to digest this. We know that these tech job cuts really have been getting the bulk of the attention. Put that into some context for us, because I believe January's tech job cuts are 158% higher than December's.
Yeah, I mean, we are seeing really large announcements from tech companies that they're going to be cutting jobs. But I think at this point, it still feels more like a correction for a lot of overhiring, maybe some hiring mania that these large tech companies got into over the last 2 years, as opposed to a tech bubble bursting, right? This idea of a real crash in the labor market in the face of a strong number like this is a little hard to digest.
And keeping in mind, obviously, that even with a lot of people cutting tech jobs, they are still hiring. So what sort of movement have we also seen as they go from the cuts to some of these other companies that are still hiring for tech jobs?
Yeah, overall, the economy just added an enormous number of jobs in January. And so while we are seeing cuts, and we're starting to see them spread just past the tech sector, we're starting to see them in other industries as well. And we'll probably continue to see that. The labor market in general is starting to cool down as the overall economy cools down. But we're not hitting some a cliff where we're having a huge mass number of layoffs that's outweighing how many jobs are still being added to the economy.
It does seem to be this sort of slow trickle here. And you do note retailers and real estate as the second and third where you're seeing some of these losses. What kinds of losses are we seeing there?
Yeah, we've started to see job cuts as well in some of those areas where consumers are starting to spend less money. So in areas that are really affected by interest rate increases, like in real estate, people are spending less on homes. Automotive, we're also seeing some cuts. And those are some areas where people are just starting to slow down their spending as things start to cool and people get a better sense of what the economy is going to look like as we move away from this kind of super inflationary period.
And what about on the flip side? Where are some of these jobs going? Which are the sectors that are really benefiting right now and scooping up some of these workers?
Yeah, well, we saw the largest gains in employment over the last month in healthcare and in food and accommodation. So restaurants and retail, those areas of the economy that are still servicing American consumers spending domestically are booming. We also saw quite a few jobs added to kind of the corporate business sector, professional and business administration jobs. Lots of those temp worker jobs as well increased over the last month.
And even in terms of location, California, understandable, being that's where a lot of these tech sector jobs are, but also Washington and New York as well in terms of states that are also seeing the biggest layoffs. How do you see that playing out? Is there a reason why it's not more distributed, especially when you look at some of these other industries that are under pressure?
Yeah, it's a good point. I think the reason we're seeing it concentrated on the West Coast right now is because of how concentrated the layoffs so far have been in the tech sector, which are overrepresented on the West Coast of the country. We are starting to see those announcements spread into other industries. And with that, over the next few months and quarters, we'd expect to see layoffs start to spread across the country in a little bit more of an even fashion.
And what about some of the more resilient sectors at the moment? Where are you seeing really the least amount of cuts? Where are you seeing at least some sort of normalcy and consistency?
Yeah, there still is an enormous shortage of workers in the retail and they call it leisure and hospitality. So restaurants, travel, people are still spending lots of money on consumer goods and durables. And that's an area there is massive labor shortages. There's still 11 million job openings in the country, a number we never saw prior to the COVID period. It's a really high number. And we continue to expect to see a lot of hiring happen in those areas. But over the rest of the year, we'd expect them to cool slightly down from this really high level where they're at.
And adding to that pressure, of course, concerns about recession, how deep it'll be, whether or not the Fed can stick the landing. How does that perhaps shape the hiring picture as well, as we're already seeing a lot of companies trying to tighten their belts?
Yeah, I mean, I think you're seeing hiring managers now take a step back and say we've been in this rapid hiring period for 2 years. A lot of companies have grown their payrolls significantly, and I think they're getting more cautious about bringing a bunch of people on in the face of some economic headwinds. So I'd expect to continue to see the say 6-month trajectory we've been on, which is the labor market slowly cooling. This month feels like a little bit of an anomaly. I would not expect to start to see the labor market really spike up in the other direction. We're going to continue to see some cooling as the Fed continues to cool down the overall economy.
All right, a big thank you for joining me this morning. Challenger Gray and Christmas SVP and Head of Sales and Media, Andrew Challenger. Thank you for joining me. All right, coming up, there's a lot more to the jobs report than that blockbuster headline number. We take a closer look at the construction sector next. The construction labor market saw strong gains in January. The U.S. added 25,000 construction jobs last month. And while employment in the construction industry grew by an average of 22,000 per month in 2022, our next guest says there is a shortage of, quote, critical condition. Here to discuss is Daniel Codsey, Royal Palm Company's CEO. Good to have you on the show, Daniel. So for a lot of people, they might not understand on the ground what this is actually doing in terms of some of these investments that we're seeing in the space and what we're seeing with the jobs here. How are you seeing hiring for construction right now?
So look, we're going through unprecedented times right now, and in unemployment, as we were discussing, whether it's the service industry, the hospitality industry, but big impact in construction. Currently, we have 360,000 unfilled jobs in construction, and so that's pretty significant. It's about a 19% increase in just since last year. It's triple the amount of openings that we had since 2014, and so that's a significant amount of openings. Couple that with the fact that we've had major increases in construction material, steel, concrete. I mean, all material costs have risen significantly. Somewhere, where overall costs between labor and material have gone up over 30% in about a 12 to 16 month period. And then, on top of that, we've had interest rate hikes, last year. So you combine construction costs, interest rate hikes, and lastly, even insurance costs have gone up. So it's a big impact on the construction industry.
And for a lot of people pulling back on expenses right now, they're not trying to invest in real estate, even though a lot of analysts say that is still the smart move. So let's break some of that down. In terms of labor, we know that Latin America plays a big part in that. Immigration in the US plays a big part in construction jobs. How much has that impacted your business?
Look, so we have a jobs program. So just to give you a little background, I'm a high-rise developer, build large mixed-use developments here in downtown Miami. It's part of Miami World Center. Miami World Center is a major master plan project in Miami. It encompasses 10 blocks, 5 blocks of retail. We have a major transportation, the Brightline high rail station that connects all of Florida. So this is really the center core of Miami. So in our jobs program, what we did is originally we started where we started taking people, unskilled workers from neighborhoods around our downtown area, gave them skills. Out of 15,000 workers, about 20% of them were unskilled. We pay them double the minimum wage so we could bring them in. We can give them skills. A lot of these people were able to expand. From an immigration standpoint, we did have a lot of immigrants that have come into the program where you took immigrants, put them into the program, gave them skills. Even women have entered the program. Women today consist of about 10% of the construction industry. So the combination of that, I've actually met some of these folks where, you hear the story where they were down and out. They came in, got the skills, moved up to a journeyman. Some people, even supervisors, really changed their life and, gave people that American dream.
And so then for people wondering just how serious is this construction worker shortage, what are some of the consequences? How bad is the situation? I know you said it was critical.
So look, it is critical. It has delayed schedules. It's just harder to get construction workers to the jobs. Our subcontractors are constantly complaining. Some subcontractors can't even bid on jobs because they just can't get workers. You used to have, 6, 8 subcontractors. For instance, a plumbing contractor. You'd have about six bids on a project. You can't sometimes get 1 or 2 bids. There were some cases you couldn't even find a plumber because they couldn't find labor. So it's pretty impactful. And so people trying to build today is very difficult. It does impact schedules. I think there will be some relief. The capital markets have pulled back out of construction, out of development. So we're not going to feel the relief in the near future, but probably in the next 12 months or so, as construction slows down, that might help the situation some.
And we know that, of course, Florida was one of the main states when we look at some of the Southeast where there was this migration during COVID. People, they wanted perhaps some looser restrictions, the good weather, the income tax breaks as well, of course. But then when you have that demand coupled with this shortage in construction workers, what does that do? And are you still seeing as much demand right now?
The demand has slowed down slightly, but there is still demand. I mean, high tax states, as you mentioned, the high tax states, and we used to not see people from places like California, for instance, move to Florida. So you have seen a major migration of high tax states to low tax states, such as Florida. Florida is probably going to be one of the few states that we're not going to see a major slowdown. We still have major inventory issues. We don't have enough inventory to house all these people coming into the state of Florida. So construction is still, as probably as the rest of the country starts to slow down, Florida is probably not going to slow down as much because of the migration into the state. And so we're going to have to work through that. Now, in some cases, when that happens, you'll see workers from other states come to states where there is jobs if the job market starts to soften. So that could be an advantage for places like Florida or even Texas, again, the southern states that are seeing the upward migration.
And certainly people will go where the work is. And as you mentioned there, Florida, at least not anytime soon, slowing down. Great stuff there. Daniel Codsey, Royal Palm Company CEO, thank you for joining me this morning. All right, coming up, we'll get the latest market action after that blockbuster jobs number. Stay with us. Well, as we close in on the noon hour, let's check in with Yahoo Finance's Jared Blickery over there at the Interactives. Jared, what do you have for us?
We have a surprising turnaround. Just want to show you what's happening in the indices. Dow is up 13 basis points, S&P 500 and the Nasdaq slightly down, but they had climbed into the green. And let's just go through some charts here. These are going to be a little bit longer term than the intraday. Here's the VIX, and I just want to point this out because we are coming off a low, a major low only yesterday, and we're also seeing bond market volatility. Here we go. Here's the B of A Move Index, bond volatility coming down too. But nevertheless, that's from yesterday's close, and that might change today because we have a lot of volatility in bonds today. 5-year T-note yield up 17 basis points. That green candle here, haven't seen a big move like that in a long time. The 10-year also on the move, up 13 basis points, and the 30-year up 9. Finally, on the short end of the curve, the 13-week T-bill yield, that is flat. Important because that really tracks what the Fed is doing. Also, the U.S. dollar index strongly up. And in these scenarios, a lot of times we see tech faltering. Not necessarily the case today. Tech is number 2, XLK on our sector list, and that's just behind energy. Financials also in the green. But I want to show you what's going on in the Nasdaq 100. We had those huge tech earnings after the bell that we've been talking about. Not going to go through all of the details there. Apple up 4%. That's accounting for a big chunk of that XLK gain. And then Amazon down about 4.5%. Tesla up 4.5%. 1.5%, and Meta up 2%. Now, Alphabet also reported earnings yesterday. Meta was 2 days ago. Alphabet down about 0.2%, but it's in the communication services group with Meta, not tech. So a little bit of sector technicality and wonkiness right there. Now, meme stocks, we can see those of our leaders group. That's in the forefront. That's up 1%, followed by gambling. That's bets, regional banks, momentum, retail, and biotech. All of those in the green. And when we take a look at some of the meme stocks, I just noticed that Carvana, well, that was up a little bit more. It's up only 5% now. Had been up quite a bit. We'll be tracking some of that throughout the day. Ape shares, those are the preferred shares, those are up 8%. All in all, I'm a little bit surprised to see as much green as we're having right now, given the reaction in the bond market. Let me just close with some of the disruption stocks. I saw some of those jumping earlier. It's mainly on the back of Tesla, because you take a look at the rest of the smaller ones here, most of those trading to the downside. And that's what I would expect with some of those yields just popping up like that. Roblox, Zoom, Square, all down 1% to 2%. So on that note, I'm going to toss it back to you, Rochelle.
All right. I mean, it's a fascinating way to end the week. It's been a big week, both with earnings and with the Fed, of course. Jared Blickery, thank you so much. Well, as we wind down what was a huge week for earnings, the season rolls on, of course, next week with another slew of big names reporting numbers as well. As you can see there, on Monday, we'll get a beat on Tyson there, so we'll understand what the consumer is feeling, especially as we're seeing what we're seeing with food inflation. Remember, we've been following what's been happening with egg prices, but also taking a look at what's been happening with food inflation overall. Checking in with the gamer Activision, you also have Spirit Airlines as well. And then Pinterest, of course, following what we saw with ad spend, a lot of people wondering what that means for Pinterest as well as they struggle to monetize. On Tuesday, we'll be getting another beat here from the energy sector here with BP reporting. More consumer spending outlooks here when it comes to food as we look at Chipotle. Hertz also reporting, as well as Royal Caribbean Group, seeing what we'll see with the leisure spending as well as some consumers going to tighten their purse strings. And we're seeing credit card debt going into historical highs at the moment. So seeing what happens with some of this discretionary spending. On Wednesday, we'll be checking in with some more food companies. You've got Wendy's and, of course, Yum Brands, but also taking a look at CVS, see what's happening with the health space there. And, of course, Disney, the big one that's going to be reporting earnings on Wednesday. That's definitely one to watch as well. As we've been seeing what's been happening with some of these streaming leaders, Disney with a lot of hands in different pots, including, of course, its parks business, but also Disney Plus as well. So keeping an eye on what's happening there. And in the payment space, you have Affirm and Robinhood as well. I'll be checking in with them as well. Of course, Thursday, Friday are still a packed day there as well. Before we go, though, let's give you that final check on markets. A mixed picture there. We see the Dow there, the only one in positive territory at the moment, and that is thanks to Apple leading the charge. Amazon, of course, as Jared was mentioning, they're dragging down the Dow, but at least still in positive territory. Up there about 43 points. The S&P relatively flat, though, down about 1/3%. And the Nasdaq, the tech-heavy Nasdaq, down also 1/3%. Well, that will do it for now. I'm Rochelle Akufo. I will be back Monday at 11 Eastern. We'll see you then. Have a great weekend.